Hello everybody. Welcome to the virtual broadcast of the annual Momentum Global Investment Management Think Tank Conference 2023. On the 20th and 21st of September, we hosted more than 100 people in the Shard, 34 floors above the City of London. We're pleased to now be able to share this with you virtually, hosted on our own event platform, over the course of the next 3 mornings starting from today. Since first introducing the virtual format of Think Tank 3 years ago, we've been able to expand attendance to so many new people in the UK, South Africa, and all the other offshore markets that we operate in across Europe, Asia, the Middle East, and Latin America. We're delighted to be able to engage with so many more of our clients and partners in this way every year. It's not as good as being at Think Tank in person, but surely is the next best thing. In a moment, I'll hand over to myself for the opening of the in-person event and a more complete introduction, as well as a preview of the speaker lineup. Before that, there are a few housekeeping points around our virtual platform. The platform provides the ability to ask questions during the presentations by typing them in the Q&A section. Members of our team will be on hand to chat and answer your questions. For viewers in South Africa, please add your ID number, and for UK viewers, please add your advisor firm FCA number to the CPD section and watch the full 3 days of the webinar to earn the points allocated. The system will automatically verify the time you watched. The virtual platform will remain open until the end of November if you'd still like to view any of the presentations you weren't able to see. After November, all the videos will be available on our events page and the Global Matters portal on momentum.co.za, as well as on the Global Matters WhatsApp bot and our MGIM website, momentum.co.uk. Thank you very much for joining us today, and I hope you enjoy the first day of Virtual Think Tank 2023. Good morning, everyone. A very warm welcome to Think Tank 2023. My name's Andrew Hardy. I'm the Investment Director here in the UK for Momentum Global Investment Management. And it's a pleasure to see so many familiar faces again with us this year, as well as plenty of new ones, of course. For those who are newer to it, it is very much an international mix of delegates here, many from South Africa, Hong Kong, the rest of Asia, across Latin America, Mexico, Chile, etc. And a handful who've made the relatively shorter journey across the UK. But far or near, thank you very much for joining us here today. This is now our 22nd think tank, and we're proud to have built and maintained such a strong following and reputation for the conference over the years, as demonstrated by some of you having attended almost every event over the years. And I believe one person, Jacques, who claims to have made every single one. So well done, and thank you. The regular attendees amongst you will appreciate it's quite a change of venue for us this year. From having hosted Think Tank in some of the city's oldest and very impressive livery halls, to what is now an ultra-modern venue and truly world-class location. We hope you enjoy the change, and indeed the views as well. Once again, we have an exciting lineup of top-level speakers sourced globally from across the investment industry to provide you with, hopefully, unrivaled thinking on the issues you face when managing and advising your clients on investments. To begin with, I'd like to take a couple of minutes just to set the scene for the day and a half ahead and provide a short overview and update on our business. Momentum Global Investment Management was set up 25 years ago to run the international assets of our parent company, Momentum Metropolitan Holdings. As one of the largest insurance and investments businesses in South Africa, with 16,000 employees and assets of over $40 billion, our parent has always provided strong backing for our UK business. And with that support, MGIM has grown steadily over the years, whilst remaining focused as a specialist investment business with a boutique-like culture and entrepreneurial spirit, and very much a global mindset, both in terms of our client base and our investment universe. We specialize in offering multi-asset, outcomes-based investment solutions, global single asset class funds, and bespoke investment consulting services for retail and institutional investors in South Africa, the UK, and numerous global offshore and expat markets. And what we believe makes us different, our USP, is our partnership mindset and our unwavering focus on delivering an exceptional personalized service to you, our clients. Those partnerships are built on the foundations of world-class investment capabilities, our experience and knowledge of the markets we operate in, our frequent and open engagement and the access we offer, our high standards and can-do attitude, and critically, a unique focus on designing solutions that help your clients achieve their stated investment outcomes. We've now grown to have $8 billion of assets under management with 75 employees across our offices, mostly in London, but also in Windsor and Liverpool. The multi-asset and single asset class investment solutions that many of you are already familiar with are managed by a 22-person strong investment team, which I'd say, given the experience, continuity, and focus across the team, is incredibly well equipped to deliver on the outcomes we target across those portfolios. Our performance delivery over many years has been built around the core foundations of a long-term valuation-driven approach, deep proprietary research, and true portfolio diversification. And it's the consistency and conviction with which we implement this, along with our focus, that I think sets us apart from so many others and makes us a valuable partner to your business. Many of you will be able to attest to the continuity of our team and business over the years, which is, I think, should be so valuable to you as our clients. It means you can place store in our track record as being generated by largely the same people and process as you see in front of you, and thereby provides confidence around what you can expect going forward. But like any business, we're always evolving, and there have been a few bigger leaps in the past year that I'd like to highlight. After over 20 years with our group, the CEO of Momentum Metropolitan Holdings, Hilly Mayer, announced his retirement this year, with Jeanette Murray being appointed as his replacement. She first joined Momentum over 30 years ago and rejoined as CEO of our group investments division in 2018. Those who know her better will appreciate that she comes with an energy and drive that I've no doubt will sustain and accelerate the progress of our wider business for many years to come. Prior to this appointment, she was also the chair of our MGIM board in the UK, so she knows these parts of our groups intimately and prizes the strengths and opportunities that we and our client base offer as a leading driver of the group's growth ambitions beyond South Africa. And testament to the importance of the international growth opportunity, our MGIM CEO, Ferdy van Heerden, has recently been appointed as Jeanette's replacement, CEO of that group-wide investments division. Ferdy's led our business since 2010 in London and has worked in the financial services industry for over 30 years, so brings a wealth of experience to this new role. His CEO role will be based in London, where he'll spend around half his time, and so will remain very close to this business, as well as looking after a much broader portfolio in South Africa, which will enable him to share that experience and global mindset across the wider business. You'll hear from Ferdy tomorrow morning with more on our business and approach. Moving on, another key development for our business was the acquisition of Crown Agents Investment Management, or CAIM, which was completed in April. This represented a wonderful niche business with very experienced and like-minded people, and a different but highly complementary client base and skill set. While we're proud of our long heritage at MGIM, it's nothing compared to CAIM, which can trace its history back to 1749 and has provided financial services to their focus markets since 1833. CAIM brought an additional $3 billion of assets under management, mostly in bespoke fixed income mandates for official institutions internationally. That's primarily central banks, for whom they manage a portion of their foreign exchange reserves. The business is led by Robert Sgrava, CEO, who previously held senior roles at the World Bank in Washington, JP Morgan Asset Management, and the Central Bank of Latvia, who's supported by several other very experienced team members that are now integrated into our investment team and wider business, all based in our London office. As well as increasing and diversifying our asset base, acquiring CAIM bolsters our direct fixed income investment capabilities, something that we'll increasingly tap into within our multi-asset solutions and through new single asset class strategies going forward. Roberts and other members of the CAIM team have joined us here today, so I'd encourage you to say hi during one of the breaks. And beyond them, there are, of course, many more of my colleagues here with us who you can pick out with these red name tags from our UK and South African teams, as well as from Momentum Wealth International, our Guernsey-based investment platform. So plenty of people to talk to if you want to know more about any of these developments or other. Onto the event itself. While Think Tank will doubtless provide you with, hopefully, plenty of insight into our investment management business and team, our focus has always been on making it as valuable as possible for you delegates, by delivering serious and value-additive investment thinking, and by placing the emphasis on what lies ahead rather than what's been before. In this way, we hope you can use the content to shape discussions and strategy with your clients. This year we bring you an agenda of 13 external speakers representing industry specialists from around the world, all of which we partner with in various capacities within our multi-asset solutions. And crucially, the speakers are the decision makers themselves, the founders, portfolio managers, and CEOs that are ultimately responsible for your client assets. We're extremely grateful for their valuable contributions to this event. Our theme this year is soft landing, hard landing, or no landing, strategies for a wide range of outcomes. When we discussed and ultimately settled upon this theme earlier in the year, we were, I'd say, quite worried that the answer may have become apparent by September. But instead, I'd say it actually seems much more uncertain than it was then, with a wide range of potential near-term outcomes for the global economy from here. This theme reflects the growing importance of developing flexible and agile investment strategies that can navigate the rapidly evolving market conditions around us. This time last year, the consensus view was that we were on the cusp of a sharp growth slowdown and potential recession, driven chiefly by high and rising inflation and the very hawkish policy response from central banks. There's been every reason to become more bearish over the past 12 months, starting soon after last year's event with the so-called mini-budget, or LDI crisis here in the UK, and associated political and market turmoil. Then the collapses of SVB and Signature Bank in the US, amongst others, in Q1 of this year, along with Credit Suisse in Switzerland, and of course the ongoing war in Ukraine, and the stalled post-lockdown recovery in China. Markets moved to reflect these concerns, particularly post the banking turmoil in March, when they rapidly began to price in interest rate cuts by the Federal Reserve during the remainder of this year, sending two-year Treasury yields falling from 5% to 3.8% in a matter of days. But winding forward, it now seems that this was a brief blip, and the all-important US economy has proved remarkably resilient, with rate expectations having adjusted higher again, and those same two-year yields back at 5%. But the questions stand as to what lies ahead. Various indicators point to a slowing growth environment, and the usual lags in monetary policy transmission mean that the effects of one of the sharpest phases of interest rate tightening in history are only now starting to feed through to the real economy. Despite all of this, global equity markets have risen 16% or so in dollar terms so far this year, on the face of it suggesting a benign market environment and assigning little risk to the hard landing or recessionary scenario. However, of course, these gains have been driven disproportionately by the so-called Magnificent Seven, which includes the likes of Nvidia, Apple, Amazon, and Meta, on the back of the AI-driven revolution spurred by the release of ChatGPT in November of last year. Those 7 stocks account for more than half of the gains of the US and global markets. Rarely before have equity market returns been so narrowly driven, which presents a very challenging backdrop for active managers. These themes and many more will permeate through all of the presentations, but with a diverse mix of speakers specializing in very different areas of the investment management industry, we expect no shortage of distinct views to be shared. There'll also be many more bottom-up, company, country, or industry-specific insights, which will highlight just how much room there is for nuance beneath the surface, and the value that can be derived from partnering with the world's leading specialist active managers, which we believe will prove ever more important in these more volatile times. Once again, we bring you an outstanding speaker lineup. I would say that, but I generally think it is. They include Callum Pickering from Berenberg and Jeremy Slack from CIBC, both macro strategy specialists. Mark Baraboo, Sunil Thakur, and Dan O'Keefe from Jennison Associates, Sands Capital, and Artisan Partners, respectively, all visiting us especially from the US, but with highly contrasting growth or value-orientated approaches to investing in global equities. Sophia Lee from First Sentier Investors in Hong Kong, who will focus on opportunities in Japanese equities, a market that we've been for a while maintaining a large overweight in, and which has quietly outperformed even the dominant US market this year. Lisa Lim and Adrian Petranu of Prusik Investment Management and Ashmore, respectively, will tackle some big questions on China specifically, the challenges and opportunities in implementing an ESG-driven approach there, and whether the slowdown there is the beginning of a slide into a Japanese-style environment of low growth and deflation. In the alternative space, Chris Tanner, representing JLEN, will outline how his near £1 billion listed investment company approaches contributing to the environmental impact challenges in developed markets through a focus on infrastructure assets. We'll also explore the latest advances in AI and investment-related application thereof through Wile Zhu and Tommaso Miglior, who both represent key strategic partners of our business in Robeco and M.M respectively. My colleague Alex Harvey will outline our views on fixed income markets, where we see much improved prospects going forward and a key role to play in multi-asset portfolio construction, before handing over to Tatiana Grill-Castro of Muzinich, who'll do a deeper dive on credit markets and where the best opportunities lie. And in a change of tack, our last speaker of today will be discussing regulatory trends in advice markets, in particular the new consumer duty legislation that's come into force in the UK this year, which is having a huge impact on the industry and which will undoubtedly inform new regulations in many offshore markets in due course. We have the wonderfully engaging Heather Hopkins from Next Wealth joining us to bring these regulation and compliance matters to life. And concluding the conference tomorrow, as ever, piecing all these expert viewpoints and insights together, will be my colleague Glyn Owen, who requires no introduction to most of you. So a packed agenda, but all in bite-sized chunks of 30 minutes each. The sessions will be hosted by a variety of people from our team, and we're planning for there to be a few minutes of questions at the end of each session. So don't be shy about asking what's on your mind. And then just finally, just quickly in terms of housekeeping matters, in the hopefully extremely unlikely event of a fire, follow the green running man signs to the fire exits, where you'll gather on levels 31 and 32 to await evacuation lifts. Or I'm told you're welcome to use the emergency staircase in that event as well, but not sure about that option. I hope you'll all enjoy the conference, and once again, thank you very much for joining us. And sorry, one other housekeeping point actually, just on CPD points as well. To get those, please make sure that you check out at the desk in the foyer area with your pass in order to get those CPD points after the event. So now, without further ado, I'll hand over to our first speaker of the day. Callum Pickering is a senior macroeconomic specialist at Berenberg Bank, who we work with in the UK for brokerage and research. He regularly features on the likes of Bloomberg TV and writes columns in The Telegraph and other media outlets, so some of you may be familiar with him already. Callum will lay the foundations for the day ahead with a review of the global economic backdrop and key top-down drivers to consider, and share his outlook from here. Callum, over to you. Thank you.
Okay, good morning, everyone. What a great pleasure it is to be kicking off this event. There's going to be lots of very market-specific stuff I imagine you're going to cover for the next couple of days, and so what I would like to do is give you an idea of what I think the framework should be. I'd say the four most dangerous words in economics are this time is different. In many respects, what we find is the actors change, the themes change, but the laws of economics and the fundamentals are much the same. We just have to step back far enough in order to see them in the right context. So the title of this presentation, and it's one I've been giving now for a few weeks, the rocky road back to more normal times. We had a this time is different once before. The first economist to come up with the idea of secular stagnation, theme we're all familiar with in the wake of the global financial crisis, was an American guy called Alvin Hansen. And he said in his 1938 presidential address that essentially all of the best gains in living standards and productivity had happened in the 100 years before, and the 20th century would be one of stagnation, frustrating economic growth. He essentially said that the Western world, the advanced world, was a sclerotic, arthritic economy, and its best days were behind it. In the end, what we realized that period was one of adolescence, of growing pains, not arthritic, and all of the best gains were ahead. And that is essentially my pitch today, that I'm optimistic. I see good reason to be optimistic. And if we lean back far enough, actually the facts themselves are very different in terms of what they say about the world today versus just a few years ago. So we all remember the new normal: sluggish economic growth, low inflation, low interest rates, chronic pessimism, a feeling that even in 2018 we could have had another decade of slow economic growth without ever building those normal, ordinary economic excesses that would lead to a recession. That era is over. There's no Japanification, there's no secular stagnation, there's no lower for longer. in many respects, despite the fact that over the last 3 years we've had 2 highly unusual shocks, what we see is a world where the baseline looks much more normal. So let's remind everyone of the shocks. COVID-19, of course the pandemic, the lockdowns, and then the Russian invasion of Ukraine. But while these shocks were taking place, we had a number of shifts in the underlying economy. On the demand side, we had an end of balance sheet repair. Banks were sufficiently well capitalized by around 2017, were in a position to take on risk and extend liabilities. Household businesses, they'd also rebuilt their balance sheets. With Mr. Trump in the US, we had a change in the fiscal tune from austerity to expansion. That's continued in the US. It's now a feature of European economic policy. And then on the supply side, we have to contend with aging populations, rising frictions to global trade. And so when we abstract from these 2 acute shocks, the war and COVID, what we find is a world that is slowly but surely actually returning to something that looks much more normal. We think we're in a world of boom-bust economic cycles, persistent inflation risks, more normal interest rates, but within that, also more normal animal spirits. I sent out a note earlier this year titled, "Miserable but Still Spending," and it was a description of the fact that around the world, consumer confidence had hit a record low. And ordinarily, that would be the signal that I would say as an economist, this is the recession signal to pay attention to. Never before had we, in the US, Europe, and the UK, reached such low levels of consumer confidence and not had a significant pullback in aggregate demand. Now, of course, we had a frustrating economic period. We had this shortage of gas in the world and high prices, but the willingness to spend was still there. We see households, workers pushing their advantage in wage negotiations. We have the return of wage growth. We see firms pushing their advantage in final markets, putting prices up, trying to defend margins. We have central banks raising interest rates, initially quite fearfully, but now with the confidence actually that the underlying economy is not as fragile, the financial system is not as fragile as we had feared. And the big lesson actually in all of this is central banks will be much less fearful in the future about raising interest rates. We've adjusted to much more normal levels, and while there's a risk that we do fall into recession over winter, so far there's no real threat that we have a systemic crisis unfolding of the like we had in 2008, 2009. The question is, why has this changed all of a sudden? In 2019, we sent out 2 reports titled The Return of Productivity and The Return of Inflation. We had anticipated, but by the end of this decade, these more normal trends would emerge. But COVID, by pure accident, the locking down of economies, the aggressive stimulus, it generated a situation where we had this almighty pent-up economic energy that was released all at once. And it sort of lifted us out of this post-Lehman funk. And so even though the fundamentals had changed actually long before the pandemic, it took this unusual one-off event to reset the economic framework. And so if you take one thing away today from my presentation, it's that we see no economic evidence now for secular stagnation. We see no economic evidence that the West is heading for some kind of Japanification. Even Japan doesn't look like it's heading for Japanification at the moment. Instead, what we see is much more normal business cycle dynamics, and that's a world in which we need to be prepared for higher amplitudes in business cycles, central banks making policy mistakes on both sides, and an upside skew to both inflation and interest rates. 2 ways in which this is already visible. The 40-year bull market in bonds is over. Now, markets are skittish at the moment. It's anyone's guess really where rates end up at the end of the year, but they won't be 0, and they won't be the end of next year either. And central banks don't ever intend them to be, which is why they're so confident with their balance sheet unwinds. We see in risk markets, this is a chart that most people will be familiar with. This is the aggregate central bank balance sheet of the majors and the Dow Jones Global Index. For a while, it looked as if only central bank liquidity was pushing up risk markets. And yet we've had this quantitative tightening, or as I prefer to call it, quantitative reversal, since central banks do not themselves intend to tighten at all with this. And yet markets are adding risk, at least in aggregate. And I know there are concentrations, but still, this represents more money being put to work. So QT is a headwind, but what we're learning, and everyone can see the inflection point there, that since October last year, when pessimism peaked, when confidence was at its low, we've had consistent upside surprises around the world to economic data, probably with the exception of China. And as a result, markets have reacted to these upside surprises by taking on risk. Great example today, UK house builders, UK banks, on the back of the inflation positive surprise. This is the world that looks much more normal. We take on risk even as central banks aggressively tighten because the economy surprises to the upside. A far cry from a decade ago. This is where my optimism really starts to manifest. Our major issue today, two major issues in fact, are supply related. The first is the aging of populations, which will lead to labor shortages. It already is. It will restrain our productive capacity. And it's the higher costs of global trade, whether that's US-China, Europe-China, Brexit, South Korea, Japan. Altogether, this frustrates gains in supply potential. But potentially, I would say, there is one offset, productivity. And this again speaks to this time is different argument. One theme after the global financial crisis was that productivity would remain weak, essentially as far as the eye can see. And this so-called productivity puzzle, if you look closely enough, was never really a puzzle. And what the chart shows us on the left-hand side is that for OECD economies, after about 2003, 2004, the rate of productivity growth actually starts to accelerate. The best-in-class companies, that's big tech, it's the best-in-class manufacturers, raise their productivity over the last 15, 20 years at a faster rate than any time during the 20th century. That's the frontier of potential, which is being pushed out. The problem is that, as you can see, the 95% of firms, the so-called laggards, essentially stuck with primitive technologies. For whatever reason, they didn't raise their productivity. Now, from an economic perspective, I can say that the one thing that we're waiting for is diffusion of technologies. And technology diffusion comes through capital deepening. When does capital deepening occur? When there's a price signal that we don't have enough productive capacity relative to demand. That's what these prices today are telling us. When balance sheets are strong enough to take on the risk of investment, and when there are solutions available to actually raise productive potential. That's AI, it's advanced robotics, it's the various advances in energy and medicine. And so the pushback I often get is, well, we've known about these technologies for a long time, even as early as 2000 for many of them, but why haven't we seen it so far? We have to be a little bit patient. Diffusion can take some time. Again, another historical fact, just to add a little context. In 1880, Mr. Edison founded a company to manufacture electrical power stations, the Edison Illuminating Company. The chart on the right-hand side shows that by 1910, about 15% of US households had access to electric power. That's 30 years after Mr. Edison founded his company. By 1930, it's 70%, and only by 1950 do we have 100% of US households with electrification. 70 years in the making. And this is the economy that had the biggest boom on the back of electricity. So diffusion takes time and it requires catalysts. And so our premise is essentially that with supply constraints coming from goods, because the global economy is at risk of deglobalization, to slightly, I would say, tone down the risks around that. We mostly have stabilization in global trade at the moment rather than deglobalization. But the aging population is certainly an issue. What we have here are the ingredients for improving productivity. And so my bet would be over the next 10 years, we should start to see a material improvement. So that's my framework. More normal interest rates, more normal inflation, more normal productivity, more normal business cycles. And with that, actually a risk over winter. that we run into a central bank driven recession. A few summary points just before I get into the country details. US, base case is now soft landing for us. Technical recession risk over winter, yes. But we had anticipated that the US would go into recession already, and it hasn't. And so we've had to ask ourselves, well, why is this the case? And we think we have some good reasons which leave us optimistic that we avoid a recession altogether. We think the Fed is done. China has big structural issues around real estate, and to understand these problems, we need to remember just how difficult it was for both Japan and the West when they suffered their real estate problems. Eurozone has an interest rate issue to deal with over winter. Gas is not the problem. Germany is probably already in recession, but Europe broadly should avoid recession. And in terms of the key risks, central banks and geopolitics. So now to some country forecasts. You see here on the right-hand side chart, our US cumulative growth forecast for this year and next has almost doubled since the start of the year. Consistently, the US has defied expectations that it may suffer a hard landing. Question is, why is this the case? I think there are probably two reasons, fundamentally two reasons. The first one is that actually in many respects the US is an economy with early cycle characteristics. There are some serious excesses in commercial real estate, and medium and small size banks are overexposed. But broadly speaking, we do not see evidence across the US economy there. We're at the late cycle stage, where when central banks, when the Fed starts to raise interest rates, suddenly these excesses unravel. These unsustainable excesses, these little bubbles are burst. That's what happened in 2006, 7, and 8. The second point is that we don't see any real evidence that US policymakers are going to make the sorts of mistakes that they made in 2008, which could turn a normal recession into something serious. It was a policy error, huge policy error, to allow Lehman to fail without covering counterparty risk. The US would have had a nasty recession, but the global financial crisis was a consequence of policymakers making a mistake. There's no evidence today that they'll make the same mistakes as we saw last year with the backing of the two banks that failed, or the unwinding in a safe way. And so what you have in the US is this perception by markets, by businesses, by households, that the system's not fragile, and where it might fail, policymakers will provide a backstop. Fiscal policy is a huge factor in this story. The Infrastructure Act, the CHIPS Act, the slightly oddly named Inflation Reduction Act, provide a huge tailwind to US aggregate demand. And what you see, at least at home, is even though much of the saving, the excess saving that had been built up during the pandemic has been spent, actually what we have now is a nice consumer upswing in the US driven by healthy real income growth. I think there are three risks that we need to be concerned about with the US. The first is that, echoing what we saw from the rating agencies, eventually the bond markets say, we don't like your fiscal policy anymore, it's too inflationary. Even the might of the US will not be able to defy the bond market. So let's keep an eye out for bond vigilantes. That would be a nasty growth surprise were it to happen. The second is, well, good chunk of the US banking sector needs recapitalization. That may provide a mild credit headwind. And then finally, US election next year will be extremely noisy. That will be difficult for risk markets, at least in the months in the run-up. China. This matters, of course, for Europe a great deal. The central problem is real estate. From afar, it's very difficult to know exactly what's going on. I think there are two observations that we can make with a little bit of confidence. The first is residential real estate excesses, when they start to materialize and when they've been associated with huge capital misallocation, are a long-lived problem. It took Japan 20 years. It took the US, Europe 15 years. It leaves the economy prone to financial risks. Now, this is a command-controlled economy. It's very different from market-based systems we have in the West, and as a result, that risk of a financial crisis is, I would say, vanishingly low. But the absence of the market mechanism where you need it also prevents the cleansing, which helps fix these problems in the end. And so it's probably the case that The short-term risks are smaller than we had experienced or Japan experienced, but the time it takes to fix these problems may be even longer lived. It also has close to horrific demographics. It's also an economy which is not yet on a per capita basis rich as the US, Europe, and Japan was. It also has geopolitical issues. And when we overlay all of this, it makes for a very uneasy economic framework. It's an economy which we think will struggle to get out of the 3 to 4% growth range, basically as far as the eye can see. It's not obvious how you could stimulate through this. For who would you build bridges for? For who would you build houses for if you went down the old route of public investment? And it would incur debt, which is something the authorities want to avoid. It's not easy to stimulate exports. Even if you could lower the currency, would the West gobble them up quite so eagerly? We learned that lowering interest rates, stimulating the credit channel, is very difficult when you have real estate overhang. Consumers are pessimistic. And so the outlook is difficult. I don't think that China will be the major driver of global trade in this next cycle. That will probably be the US and European consumer. For Europe, the story is, at least from afar, fairly stable since the invasion last year. No growth in real GDP, virtually no growth in real GDP. But the story is really split into two halves. During the first phase, so that was probably spring last year until early summer, the major issue was supply. Would we have enough gas? And so we had this real constraint from the supply side. By and large, those risks have disappeared. What we now need to be concerned about is whether or not the ECB has already done it with its rate hike cycle. I don't think it has, but the point is, until spring next year, what we have to worry about is demand. And so it looks as if real GDP is flat over this period, but the first half of this flatness is a supply problem. The second half is a demand side problem. The good news is, it's much easier to cut interest rates than it is to try and produce a load of gas very, very quickly. So if we see that there's an obvious policy mistake in the pipeline, from these fairly normal levels of interest rates, there's some stimulus. You see the big issue for Europe earlier, global supply linked to COVID. That is now unwinding. And, well, the detail in this chart is actually not that important. It's just to say that we need some very extreme, weird developments next year and the year after for Europe to genuinely fall into gas shortages. Prices may be high over winter, but the idea that we won't have enough gas seems to be remote. Let me make a point about the UK. We've duly suffered as a result of the noisy politics, no question. But underlying that, actually, fundamentals look fairly good. The banks are extraordinarily well capitalized, household balance sheets are in good shape, but chiefly, businesses are in good shape. We have a good 25% of GDP in cash sitting on business balance sheets. That's almost double what it was 20 years ago. Debt is at 1990s levels. We have the strong price signal. We have the labor shortages. We have an improving political environment, less uncertainty. Probably we have a boring election next year. Can you imagine it? Especially compared to what we'll see in the US. And even though markets are still very nervous about the UK, relative prices still at a 30-year low versus global equities. But if we look closely, what we see is businesses are betting their pounds on the UK economy. We have a 35% increase in business investment since the middle of 2020. And there's no sign that this is slowing down despite all these uncertainties. And so the money on the ground is sending a very strong sign about the UK. I think this is important. In many ways, this is the key chart which loops back to the initial point around productivity and around the return to normal. Let me summarize now just with central banks. Inflation is falling nicely. Most of that is mechanistic at the moment because of the energy price base effect. We think we get two handles in the US, the UK, and the Eurozone next year. By 26, 27, we probably edge towards 3% again. Inflation expectations now are fairly well behaved. We think that central banks are more or less done. At least the Fed and the ECB are. Maybe we get one more from the Bank of England tomorrow, but it's not obvious. And then probably by next year we see gradual rate cuts. It's hard to imagine a world where central banks provide a lot of help for markets in this inflationary environment. So nowhere do we expect rates to go below 3%. But by and large, removing the tight element of monetary policy when economic fundamentals are good is a sufficient condition for economic growth to improve. And so I make a constructive macro case overall. I think we need to worry about recession seriously over winter, but more likely than not, we're on track over the next 2 or 3 years after these very odd shocks fade to return to what will be much more familiar economic performance, behavior, and if we just peer closely enough into the data, amid all of this stagnation that we see underlying behavior look much more normal already. And for me, that is the key thing to emphasize. And so let me stop there. I think we might have a couple of minutes for questions.
Thank you very much. Callum mentioned Japanifications a few times, and certainly Japan has gone through a very long period, many years, as you guys will know, of low growth, low inflation, low interest rates. Many global investors have given up on the market, thinking it's sold, it's unexciting. But I would argue, actually, Japan offers really some interesting opportunities for those, willing to maybe turn a few rocks around and discover hidden gems. There is innovation, there is IP, there is global players as well as niche small companies. So please, welcome on stage Sophia Lee, Portfolio Manager at First Century Investors, who will tell us a bit more about how she spent the last 10 years.
Thank you everyone for your time today, and thank you Lorenzo for giving me this opportunity to present the unique investment opportunities that we find in Japan. And when I think about Japan, often there are 3 words coming to my mind. One is it is misunderstood, and then second, it is under-researched, and then thirdly, it is underappreciated. I think for the global investors, when they think about Japan, as Lorenzo mentioned, we often think about the country as having no growth and having low return, and also there has been a gradual loss of the global competitiveness due to the aging population, which we actually humbly disagree. In fact, for many years, Japan has been maintaining a remarkably strong position in the R&D globally and also the intellectual property rights. Japan has been constantly actually having the #1 market share in the triadic patent families in the world. And it also is one of the top R&D spenders in the world. And another key indicator we look at is the economic complexity index, which is used to measure the value added of the products that a country make, and also the resilience of the externally facing economy. And Japan, in fact, has been the leader in the world for many years in terms of the economic complex. And then last but not least, despite the aging population, the labor productivity in Japan has been on par with the United States in the past 50 to 60 years. Secondly, Japan is also the most under-researched market among the major global equity markets. As you can see on the chart here, actually more than 70% of over 4,000 listed companies in Japan are covered only by one analyst or have no coverage at all, which is the opposite of the United States. So given this high level of market inefficiency, I think it looks quite exciting to the active investors because it provides a very large pool of the hidden gems for us to discover before they are well appreciated by the market. So what are the key major investment themes that we identify in Japan? And then today I will mainly focus on the 4 investment themes in our portfolio. So first of all, actually, Japan has a very large number of the companies that have dominant global market share in the niche industries, which has very limited competition and is also protected by very high barrier to entry. As a result, for these type of companies, usually they have very strong pricing power. They generate sustainably high return on capital employed, and also generate reasonable, medium-term growth backed by the strength of their franchise. price. So one key area where we find many investment ideas is the semiconductor equipment and also material industries, and which I will elaborate later after this slide. The second investment themes in Japan is the multi-year trend of digital transformation. Digital transformation not only applies to the fact that the companies need to spend more on IT spending to upgrade their proprietary IT system, but also they need to accelerate their pace in terms of upgrading to the cloud services and also the software. Lastly, Japanese companies have been lagging behind the United States in terms of the digitalization of their business model. And the government actually is very well aware of these problems. So back to 2 to 3 years ago, actually the government has set up the digital agency in order to make more initiatives to push the Japanese companies to adopt digitalization. And I will talk about more investment opportunities later. And then thirdly, as I just mentioned, because of the lack of coverage of the stocks in Japan, and there are many attractive mid to smaller cap companies which have very strong franchise, very interesting business, but their valuation is below the comparables in the large cap space. And this is also an area for us to generate investment ideas. And then last but not least, we also maintain a balanced approach, and we also invest in a number of large cap, globally competitive companies positioned in various kind of industries, such as like entertainment, factory automation, and also medical equipment. So yeah, this slide is about the opportunity set we find in Japan in the semiconductor market. As we know that the strategic value of semiconductor has been continuously rising in the past 10 to 15 years, especially after the supply chain disruption caused by the COVID. If you look at the semiconductor content in a car, so it virtually will double if you compare an ICE vehicle and also electric vehicle. And then another example actually is the AI. As you know, that semiconductor is enabler of advanced AI GPU chips. And as a result, companies which are positioned in the cutting edge semiconductor industries will be the major beneficiaries. If we look at the chart on the left-hand side, as you can see here, for so many cutting edge technology and products, Japan has the dominant market share in the world, more than 80-90%, and for some technology is close to 100%. And then in our portfolio, actually we invest in a number of hidden gems in this area, which is not very well known among the global investors. For example, one company is called Ajinomoto. This company actually invented ABF, which is a very important type of insulating material applied to advanced packaging, which is used to make CPUs and also AI GPUs. And as a result, the company is a de facto standard in the world, and they have 100% market share. And for this product, they generate more than 50% operating margin. Another example is a company called TOK. So this company is the second largest semiconductor photoresist manufacturer in the world. Actually, semiconductor photoresist is a very important type of material, and actually top five Japanese companies have more than 90% of the global market share. And for TOK, they are the second largest with about 25% market share. And then one more example is a company called Fuso Chemical. This is another global monopoly. It is small cap. The company doesn't really, publish any English presentations and so forth, but they actually have 100%, again, 100% market share in a type of chemical called high purity, ultra high purity colloidal silica, which is used to polish the semiconductor wafers and also used in the CMP slurry materials. So all of these companies, actually, their valuation is quite attractive. So for some of them, it's only about like 10 to 12 times PE, and they are not really well known in the market. Then then this slide is mainly about the digital transformation. So despite the strong need for digital transformation in Japan, but the country has suffered from the severe labor shortage of talented IT engineers. Because of the historical background of the Japanese society, so actually only 30% of the IT engineers are working inside a company, while in the United States it's more than 70%. That means that for the large Japanese companies, they have to rely on system integrators, large IT service companies in the country to hold their hands and then build up their IT system and tell them what are the next cutting edge tools to use. So as a result, the key beneficiary of the accelerated spending on IT will be a strategic and IT consulting company, which help a company to rebuild their business model and also their internal system. And another example would be the leading IT services companies, because they can benefit from stronger pricing power and the more orders in the years to come. One of our top holdings is a company called the Bay Current. So this company is one of the largest IT and the strategic consulting company in Japan. And their business model is a bit like Accenture and also McKinsey in the Western world. So for this company, they have delivered more than 30% CAGR growth in the past many years. And they, thanks to strong orders from the large blue chip companies to transform their business model. Operating margin, ROE of this company is also top-notch in the world. And another stock example is a company called Shift. So Shift is actually a relatively, newcomer to the industry. So they mainly handle the outsourcing services of software testing for the Japanese large enterprises and IT services companies. Because of the labor shortage in the country, so there is more and more outsourcing works from the IT services companies, and then Shift actually can automate this process based on their AI software and so forth. So, and one more interesting about this company is that actually despite the relatively small size of this company, because of the charisma of the CEO and the founder, he managed to hire the ex-CEO of Keyence, which is a leading global machine vision system company in Japan, to become the vice president of the company. As a result, the company has been actually building up their HR system, sales management system, and so forth. And the growth has been phenomenal, actually, in the past many years. Thirdly, I would like to talk about a couple more hidden gems in Japan that we find. And most of these companies are barely covered by the market, but they have very interesting business and also strong franchise. So first of all, this is a company called Roland. So if any of you have have a hobby of playing electronic drum at home, I think more than 70% chance that you may have a Roland branded electronic drum. This company actually has a very long-term history. It is highly innovative. They have managed to invent many of the industry first products in the electronic instrument industry. So they have more than 65% global market share in the electronic drum, and they actually provide a full lineup of electronic instruments such as digital piano, wind instrument, and so forth. And actually the barrier to entry for this industry is quite high, because the company actually has the proprietary technology of designing their own semiconductor chips to simulate the sound environment under different kind of external factors. So for example, they can simulate the sound quality in like big music hall versus at the suburban areas. So it's complete different actually sound effect. And the company is one of the only 2 companies in the world that have possessed this technology. Partially also because it's not a sexy industry, so there's a limited competition. And the result, the company enjoys a very strong pricing power. Another company is called Shoei. This company actually has more than half of their revenue exposure to Europe, and then they are the leading manufacturer of a premium motorcycle helmet with more than 60% market share. So the company is very focused. So they're very passionate about motorcycle helmet. Obviously, the more fancy the shape is, actually the harder it is for the product to pass the regulatory approval. But the company keeps challenging it. So that's why they have the top global market share in the motorcycle helmet industry. And then for these companies, actually, despite their strong track record, franchise, sustainable growth, but because of the lack of reputation in the market, actually the valuation is very attractive. And then lastly, in Japan, among the large cap space, we also invest in a number of companies that have transformed their business model to become quite globally competitive. A good example would be Sony. I think maybe back to 10 or 15 years ago, you would consider Sony as a house compliance manufacturers, and they've been losing to Apple and the Chinese manufacturers in the smartphone, TV, and so forth. But on the other hand, in the past 10 years, Sony actually has already restructured the business itself, and now they mainly focus on two businesses. One is the entertainment industry. Sony is the largest game console manufacturer in the world, with more than 40% market share and competing with Xbox. And then secondly, the company also runs the top music publishing company in the world, and also their movie business is also one of the top 5 in the world. So in overall, actually more than 60% of Sony's profit today is from the entertainment business. And then another key business of Sony is the CMOS sensor. So every year when we expect the launch of a new iPhone, the major change actually is the camera quality. And actually it's all empowered by Sony's CMOS sensor. The company has more than 50% global market share in the CMOS sensor, and they virtually has a monopolistic market share within Apple. And the next growth driver for the CMOS sensor will be applied to autonomous driving. As you can imagine, we need a lot of high quality and robust sensors for the future cars to make their own decisions. One more company I would like to spend some time is a company called the Recruit Holdings. We also have invested in company for a very long time. So Recruit is a global leading HR and the marketing media company. And the company's historical business model is online job board. But the company already witnessed the transformation of the business model in this industry. In the future, and even today already, employers are no longer to be willing to pay a fixed fee for a job advertisement to be listed on their website. They want to pay for performance. They want to hire people at the fastest pace with the smallest amount of money. So as a result, Recruit actually made a very good acquisition more than 10 years ago. And now today, they own the largest job search engine in the world called Indeed, which has #1 market share in the United States. And that they also have the top franchise in some of the developed markets like Germany and also UK. So I think Recruit is a very good example, which is opposite of the typical Japanese companies. So basically, the management told me that if we know that one day we will be displaced by another competitor, a new business model, then we would rather displace ourselves first. So as a result, the company made a very smooth transition to a new business model. And then the Olympus, it will be very quickly. This company is a global leader in the gastrointestinal endoscope. It's another very niche market protected by a high barrier to entry. And then the company has more than actually 70% market share in this industry. And then lastly is Keyence. Keyence is one of the largest machine vision sensor manufacturer in the world with more than 25% of market share. So these are just some of the examples of the top global franchises that we discovered in Japan. And then lastly, I will probably use two company examples to illustrate what's our investment process and what kind of the key opportunities we find in Japan. So I briefly mentioned about Ajinomoto. So this company is a very interesting story. So basically, they are a very traditional and historical seasoning and seasoning manufacturer in Japan. Basically, it was a food company many years ago. But in 1990s, when Intel tried to transit their technology to the advanced packaging substrate, so they tried to recruit a material manufacturer. And Ajinomoto actually they applied their technology in the seasoning market to semiconductor. And as a result, they become the monopoly of the ABF, which is a very important semiconductor material. And today, they have 100% market share. Actually, for ABF, the key growth driver is the HPC, the data center. As you can see that the data center growth will be phenomenal in the next 10 years, mainly driven by the AI training and the inference functions. And for ABF, in 2020, already more than 60% of the demand is from servers, data centers, and then by 2030, actually will be contribute to more than over 80%. So the company actually is a major beneficiary of the strong growth of a data center. On the other hand, the company is also a very good case of restructuring in Japan, because in Japan, we can find many good franchises, but they were mismanaged by the management because they tend to be relatively stubborn and also inward-looking. But for Ajinomoto, since a few years ago, so they have the new CEO, and then he started to restructure the company and then focus on improving the overall ROIC of the company. So as a result, the ROIC of the company has improved from 3% in 2019 to more than 10% now. And they actually aim to double that by 2030. In the meantime, they also want to triple their earnings per share in the next 8 years. And also, they also commit to paying out more than 50% of their total profit in a combination of dividend and share buyback. So basically, Ajinomoto is a role model of the corporate restructuring stories in Japan. And since Japan is a very homogeneous society, if we have more and more this kind of role models, the rest of the peers will follow. And that's why we believe that ROE in Japan can structurally improve from here. And then the last company example I will present today is a company called Lasertec. So this company is a global leading semiconductor equipment manufacturer, and they are very good at mask blank testing equipment. So for this company, although it's a relatively small company, they have less than 900 employees, almost only less than 1/10 of their global competitor, KLA, based in US. But the management is very visionary. They already foresaw the upcoming EUV era, so the extreme ultraviolet technology used for advanced semiconductor. As a result, they worked with the global leading semiconductor manufacturers like Samsung and also TSMC to develop the EUV related equipment. So nowadays, the company has, again, virtually monopolistic market share in the EUV mask blank and the photo mask inspection system. And the margin of their product is superior. ROE of the company in the latest year is over 50%, and their order backlog also virtually doubled, as you can see on the chart here. So this is, again, a very good example of a hidden gem in Japan, which used to have very small size, but they are able to beat their global competitor thanks to very superior labor productivity. Yeah, so I think this will be the end of my presentation today. I hope that my presentation could add some value to your understanding of Japan. And then if you have any questions, please let me know. Thank you.
Right, next, a speaker who will be very familiar to those of you who have attended Think Tank over the years. Mark Baribeau is Head of Global Equity at Jennison Associates. He is the co-portfolio manager of the Global Equity Opportunity Strategy, which has been part of our funds for over a decade. Since that time, the strategy has returned 13.5% per annum. That is 4.1% ahead of the MSCI World Index, again per annum. Mark presented at Think Tank last year. As we approached the bottom in equity markets, he was very honest about performance. I think you said it sucked, Mark. But nonetheless, he said conditions were increasingly in place for things to change. And since then, the strategy is up by around 22%. I think I was looking on Friday. That's ahead of the MSCI World Index, ahead of the Associated Growth Index, and ahead of the Associated Momentum Index. So take your pick. Our analysis concludes that the strong performance Jennison have delivered over the short as well as the longer term is down to skill and not luck. But I will let you make your minds up on that by promptly handing over to Mark. Ladies and gentlemen, Mark Barabow. Thank you.
Thanks for that introduction. I'm glad I'm here this year and don't suck anymore. So I'm gonna try to go through a lot of material really quickly because there's a lot to talk about. There's a lot of interesting things going on in the global marketplace that are quite exciting. So I'm gonna hit first on sort of current market dynamics, just what's happening in growth stocks generally. Put it in perspective of the longer term, both in terms of valuation and scarcity, and then talk about where the opportunities we think are today that are providing the good returns so far you're seeing this year, and in fact in the trailing 1 year, and looking forward into 2024 and beyond, because there's big structural shifts going on right now that are quite interesting. So let's go fast forward. Well, first, there's a lot of little bullets on here, hard to read, but essentially 2021 into 2022, you just had a big drop in valuations because interest rates rose very rapidly. But for growth stocks, there was an added pressure. There was a real concern in the marketplace about demand pull forward for goods and services that, the big tech leaders, e-commerce leaders, media companies, certain healthcare companies were delivering during the pandemic, where their secular growth was very robust, but then it accelerated. And is there going to be a lot of demand pull forward and give back in 2022, 2023? And there was in some cases, there wasn't others, it was not. But that uncertainty really weighed on valuations. By June of last year, you kind of cleared the decks on a lot of the, at least expectations. So there were still concerns ongoing in the marketplace, but valuations had reset, and that was very important. So the opportunity set we see now going forward is in 5 principal areas, but I'm going to only talk about a few today. Number one is the generative AI boom. That's going to be the 4th era of computing. It's really significant, and we think it's important to have the portfolios focused there. Secondly is what's going on in consumer brands and consumer models in general. The direct-to-consumer model is far superior. That is, you can only buy products from a brand through their retail distribution or their e-commerce site. They control everything, the engagement, the pricing, the inventory. They're winning big in the marketplace globally. Others are faltering. Third, the big transformation in mobility. This is going to continue. Obviously, it's the move to electrification and autonomous driving. Both are a collision course for the traditional auto industry, which is not going to be able to handle it well. Most of the profits coming out of that transition are going to go to technology platforms. And then lastly, we'll talk a little bit about the reindustrialization of some developed economies, particularly the United States, as everybody tries to move aggressively out of China and reliance on that supply chain. So, a lot to talk about. First, just why do we focus on growth? Those blue bars, this is since 1997, rolling 5-year returns. That top quintile of growth in the market generates very high double-digit returns, high teens. The second quintile, also very powerful. Those are more of those durable, low double-digit growers. Great place to invest as well. Almost harder to find than the special ones because it doesn't last as long. Last year, in 2022, you can see in the green bar, all flipped on its head. Very unusual. The faster you grew, the worse you did as a stock. The slower you were growing and not growing at all, the better you did. That just reflected the valuation shift. It's right sizing this year. So far through the first half of the year, that top quintile is driving the market globally. And of course, we all know about the concentration of the market. It's now called the Magnificent Seven, which I don't know who termed that, but it's better than FANG. We're happy to see it. Why is it so powerful this year? Valuations. If you look at the left side of the page, this is growth relative to value. The relative PE almost dropped to parity for very powerful growth franchises. The lowest since 2008 in the financial crisis. Even with the big rebound so far this year, it's barely moved off the bottom. You haven't missed a thing if you're not invested in this part of the market. It's just beginning. Growth is very concentrated over time. If you go back to 2005, we look at rolling 3-year revenue growth and earnings growth production. That little green sleeve, that's companies that are able to grow their revenue 7 to 12%, 7 to 15% a year, earnings per share growth 10 to 20, a very small part of the market. The faster growers, that light green or whatever color that is, grass green, I guess, is even smaller, only 11% of the market. That's companies that can grow revenues faster than 15% a year. So only a quarter of the global stock market has the power to grow top line. It's really small. Why does that matter? Because most equity returns over time are concentrated. They're not distributed in the market. This is a famous study that came out a couple years ago. If you look at the US stock market, 1926 through 2019, that's a long time, 4.8% of stocks over that entire time period account for the entire wealth creation of the stock market. 4.8, that's it. If you look at MSCI All Country World, it was launched in 1990. You do the attribution there. 1.8% of the stocks in the global stock market index account for the entire gain of MSCI All Country World since 1990. 1.8%. Returns are not equally distributed. You have to be in the big leaders that are making huge difference in the world, scaling their operations, and generating tons of cash flow. Those are the big winners. That's why they keep dominating today. I'm going to jump ahead to style quickly. The other reason growth is bouncing back this year, the global economy is slowing. When earnings growth slows, and it's less than mid to high single digit, the blue bar on here, growth stocks dramatically outperform. If earnings go negative in the market, like a recession, it's even a bigger spread. So one of the reasons we're pretty confident about the setup this year is we entered 2023, we had valuation on our side, and we had earnings growth on our side. And so far it's played out, and I don't think that's going to change in the next year. Where are we focused? Okay. The only technology that matters going forward is AI. This is the next big megatrend that we're all looking for. Where is it going to come from? The mobile internet was the last big one. It lasted more than a decade. It powered all these great stocks, Apple, Google, et cetera, Facebook, because of the fact that you could transform all that information and carry it with you and compute in your pocket was a big deal. And it created applications we never dreamed of years ago. So the new one now is generative AI, these large language models that are are going to enable us to do more creative things with fewer resources, more productivity, better applications coming from software companies. Think of it as a personal assistant for you and I to do all sorts of planning, execution, buying on day-to-day living. ChatGPT was launched on November 29th last year. It's the fastest app to ever get to 100 million users in history. And you can see, I mean, it's a straight line up. And that's why there's so much interest in this area. It took the world by storm. All technology companies that we follow are pivoting all of their future product planning to embed this either in their workflow for their own productivity purposes or for applications for their customers. So it's here and now. It's not hype, and we'll see in a minute how you think you play it. You can't really invest in the application layer yet. It doesn't really exist. You can play around with ChatGPT, but you can invest in the infrastructure layer. This requires enormous compute power, and it starts with silicon. So you have obviously NVIDIA. That's the powerhouse of the global stock market this year. It is the must-own stock for this generation, but there's others. If you think about a Tesla, they train their autopilot on NVIDIA GPUs. They're also trying to build their own supercomputer that can handle that load. And then once the algorithms are trained, they download that software onto your car. The car has its own application-specific chip, the brain, that runs all those cameras, gets all the information, and drives the car in real time with no latency. So the application-specific chip at the edge of AI is going to be very, very important, and they're very powerful. And so a company like Broadcom, which is a leader in the manufacturing of these or design of these, is key. Down the food chain, the sophisticated nature of semiconductor design today, because Moore's law is dead, you can't keep just shrinking the chip. It just has to get more and more sophisticated, like City on a chip. You need the architecture. That's Cadence Design Systems. As it goes AI, it gets more powerful. And you have a massive supply chain shift out of Taiwan, effectively out of China, although China is also building its own semiconductor capability in the United States, Europe, and Japan. So you have a building boom going on. That benefits ASML and Applied Materials. On the cloud computing side, the middle part, all the workload so far for AI is going to occur on these big data centers. Microsoft Azure is in the lead because ChatGPT, OpenAI, is on that platform. So if you're using ChatGPT, it's going right to Microsoft's Azure data center. So far, Google's not a big player in the new generative AI market. They're obviously the largest AI company in the world. But the generative AI market, they're not a big player yet, although they're working on it. And Amazon AWS is really getting no revenue from this yet. But given what we know about capacity, it's inevitably going to leak its way into all of these big players. The software side, we don't know what's happening yet. We can't really tell. We do know that you have a non-traditional, non-structured data. So you have video, text. Think of Tesla. It's all video. It's camera shots. There's a lot of information coming in that's not pieces of data. It's unstructured. So you need an unstructured database to manage it that's cloud-based. That would be MongoDB. We think they're going to be a winner from this. Their business is already accelerating this year just from their base business, but we think it could be a platform company for generative AI. We just don't know yet. But the business is doing fine already. Why is NVIDIA so important, and why is this not hype? Well, this is real revenue. NVIDIA shocked the world in May. We call it the big shock day of AI. They raised their revenue guidance for the next quarter by $4 billion, from 4 to 8 for data center. That kind of revision is unprecedented in the history of my tech investing going back to the mid-90s. It just has never happened before. So their data center revenue is going to more than double this year. Even these estimates are a little old right now. So they're the lead player. You need their GPUs to run these systems. That won't be true forever, but it's true now, and it's true for the next 1 to 3 years. So meanwhile, valuation on this stock has collapsed, because that's the other question people ask. It's up 200% year to date. It's the biggest holding in our portfolio for Momentum, thankfully. And its PE multiple on next year's earnings on consensus is 27 times. It's not expensive. And it's because of the huge revisions upwardly in the stock. How big could this be? Well, if you look at data centers and cloud-based computing, it took 18 years to get to 100 billion of revenue. That was through 2018. It then took only 2 years to do the next 100 billion. So we think, it's reasonable to assume that, and this is Piper Sandler estimates, but we think it's realistic. You're going to go from 2 billion to 100 billion in 8 years, maybe quicker, but it's not going to take 18. So again, big addressable market opportunity. That's a lot of money going into technology products and services. We have to be there. Semiconductors are the other big beneficiary. The blue on this chart is the fourth era of computing. The red, the last one we just came out of. So generative AI will be the fourth. It could be the biggest, but it's going to be significant. It's going to take the semiconductor industry to $1 trillion in revenue by 2030. And we talked to the semiconductor companies, and they all kind of bless this number. They actually think it's likely. And that means a big CapEx boom. And here's the subsidies that are being thrown around the world. I mean, it's $66 billion in the US. It's Europe, 47 billion. China, 143 billion. So China's trying to build its own semiconductor industry as well. So lots of picks and shovels here, lots of equipment sales. You probably don't want to own a semiconductor stock when all this capacity gets built, but the equipment plays should be pretty good for the next few years. So we want to be positioned there. That's like an ASML or Applied Materials. Valuations. All right, let's compare this period right now to prior booms. If you look at the last one, the internet era, March 2000, the valuations today are nowhere near where they were back then, or the peak, which is that sort of zigzag line for the leaders. We're not anywhere close to it for the cluster of AI stocks that you can kind of put in that bucket. And even in the NVIDIA number on the far right of this chart is old. This chart's a little old. It's actually lower than that. Why? All of these big tech leaders, these AI leaders, including NVIDIA, generate a ton of free cash flow. They have very high free cash flow margins versus the internet peak in 2000, free cash flow margins were negative for the leaders. And today, they're the best in the market, in the entire global stock market. So it's a lot of valuation support here because of the free cash flow. All right, switching gears, direct-to-consumer models. This is the other big trend that's out there that's just showing up now in the last few years as driving massive differentiation in consumer brands. So what do we mean by direct-to-consumer model? If you think of Hermès, if you want to buy Hermès, you can buy it in their store or on their website. You can't buy it anywhere else. If it is sold in a department store, it's going to be a high-end one where they are controlling the shop. The department store doesn't get to touch a single thing. And the reason is this direct-to-consumer model enables them to control their engagement with their customer, the experience, all the remarketing campaigns, and most importantly, inventory. So they don't get involved with excess inventory in a part of the world or a part of the channel they weren't anticipating. They can control it all. They can move it quickly. And their supply chains tend to be vertically integrated because they have these models. It's not just luxury goods. It's also companies like Lululemon, same kind of direct-to-consumer model. These brands, if you match them up, compared to the broad market, here it's luxury goods versus Europe, return on invested capital, dramatically higher and expanding. If you were to compare these direct-to-consumer models in general to non-direct-to-consumer models, same trend. They're winning big in the marketplace globally because of that control, and you just have to have it today. The other thing is in mobility, I think I've showed you this chart before, but EV penetration rates, as you know, are rising rapidly. China's sort of past the inflection point. It's above 20%. It's now really going to accelerate. Europe is almost there in general. There's puts and takes. And the United States is still just below 10%, but that's moving quickly. And you can see the numbers here. That dotted line is the year-over-year growth. It's around 50% in July. So this is with all the economic concerns, and and China is the weakest market with units up 32% in July, although they're up 43% year to date. But Europe, units up 50% year over year. The United States, units up 50% year over year. Those are the three big markets in the world for autos. Combustion engine sales are mostly negative year over year. So this is a big, big difference. By the way, you can see in the bars, China in the blue accounts for about half of all EV production and sales in the world. When you think about an industry going through a massive disruption, there's always a driver, no pun intended. There's the disruptor, which is Tesla. Comes out of the blue, changes the game, the rules of the game real time. And the incumbents say, no, nobody wants them. Where do you plug it in? Blah, blah, blah. And meanwhile, consumers en masse are just flocking to it. And then there's the sort of the copycat version where we can manufacture them faster, cheaper, not necessarily at the high end, but good enough, and take a huge part of the volume market and then win. That would be the playbook of Toyota 40 years ago and the Korean automakers 30 years ago. Well, guess who they are today? They're all Chinese. So watch out for China. They're about to dominate the global auto industry because of this move to electric vehicles. By the way, in the first half of this year, the Tesla Model Y became the best-selling car in the world, passing Toyota Corolla. So the baton has been passed to the next generation officially. But there's more disruption coming, particularly since the move to EV also involves the move to autonomous driving, which plays into artificial intelligence. We think there's only going to be 3 companies that play in this market going forward. It's going to be Tesla with a leader, and either NVIDIA and Mobileye as the counterweight in the industry, as all other OEMs are forced to buy their technology to compete against Tesla. So that's what we think is going to happen, including in China, by the way. The other interesting trend is this onshoring of supply chain. We read a lot about it. Some people call it deglobalization. I don't think there's any deglobalization going on. It's de-Chinification. Let's be honest, that's what it is. And it involves also issues of security. So that's why the biggest move, the biggest boom is occurring in leading edge technology. It's not occurring in traditional manufacturing. So when we look at, this is just the US, this is construction spending on manufacturing. I mean, if that were a stock, we would buy it. We wouldn't even look for a pullback. We'd be plowing in, I'm sorry. This is a really important move. And it's occurring in electric vehicles, battery, storage, and alternative energy tied to that. And it's occurring in semiconductors. That's where the big money's moving. So we're trying to get ideas into the portfolio that can participate in this sort of, again, picks and shovel boom that's going on. I'm going to skip a couple of these. I mean, just quickly, 670 billion mega projects announced in the US and Canada related to this. These are big numbers. It's going to be wild. And this one just shows, it's the blue line. It's leading edge technology where all the building is, traditional manufacturing, the orange line going nowhere. All right. Quickly on the portfolio, you heard the numbers, year to date, up over 30% in excess return of 17 plus. What's driving it? Well, earnings per share growth in the portfolio is running at more than double the market, 14.7%. These are real numbers, not estimates, and dramatically higher than the S&P 500. So it is working this year. Companies that are putting up very strong double-digit fundamental growth are winning again in the stock market, which is really important. For us, if you look at the far right of this page, the attribution, it's all coming in a few areas. Our technology portfolio is leading, 800 basis points of alpha this year, followed by our consumer portfolio at just over 700 basis points of alpha, broadly defined. Then you look at fintech, that's another 100 plus, not owning energy is 100, and then healthcare. So all the areas we're very active are really driving performance. So again, a reversal of 2022, kind of back on track. The big winners are on the left side of this page. NVIDIA leads the way. That's 5.1% of alpha, so 5.1 percentage points. This was a big holding coming into the year. We added to it in December. We had owned it. We had cut it back early in 2022. We added back to it in December on our belief that their gaming business, just computer games, were turning the corner after digestion from post-COVID, and that the data center business would reaccelerate driven by AI. We had no idea it was going to be this big. But, it is what it is. In the top 10 includes other technology companies, including Palo Alto Networks in leading edge network security. It's really important to secure all this massive data traffic. And we think they have the leading edge going into cloud-based data security. Broadcom in ASICs, and then Cadence Design Systems and ASML in sort of the building blocks of the chip boom. The rest is consumer, and it's very diverse. There's luxury, the direct-to-consumer models, Ferrari, Hermes, LVMH, Mercado Libre, the e-commerce and fintech giant in Latin America, the Amazon of Latin America. Never missed a beat last year fundamentally. The stock went down 45% on positive revisions. And so this year it's played a huge game of catch up as a stock because the business was never shaken. And then Tesla. So that's where the performance is coming from. This is our top 10 at the end of June. I'd be happy to take any questions. I know we covered a lot of ground there.
We'll now have a short comfort break. Please take the opportunity to grab a cup of coffee and enjoy the short videos we've lined up for you in the meantime.
We've just concluded our think tank conference for 2023. Having had this event now for this is the 22nd year, we've pulled together probably the best and most diverse range of speakers that we've ever had from right across the world.
Fantastic conference. Be exposed to such a wide range of speakers who are subject matters experts on all sorts of different topics at a time when the world is going through so much and there's so much uncertainty. Was just fantastic for me.
We've got some of the best fund managers from all over the world speaking at this conference.
The venue has been fantastic. We're obviously on level 34 of the Shard, which has been brilliant. Probably the highlight for me has been the M.M presentation, which talked about sort of generative AI and analytical AI and how Momentum is utilising that.
As usual, the conference was very professional. It's very well organized. A lot of time was spent on artificial intelligence, which was good to hear.
Highlights, I suppose, is being a social person, is mingling with people from all over the world. That was great. I think it shows a couple of things, that Momentum is truly a global business, but also the world is a globalized world. It was good to hear the commonality between ourselves and some of our colleagues and clients from around the world.
When you come to a conference like this, obviously you want it to be educational, that at ease, you want to learn something, and I learned a lot for sure. But you also want it, to be well organized and to run smoothly, and Momentum really achieved that with this conference.
The turnout for all of the sessions has been fantastic. Really high turnover. I think it's the highest that we've ever seen. A lot of the sessions have been standing room only.
I really learned a lot. I'll definitely be back for the next Think Tank conference.
For us to hear that feedback and to listen to the quality of presentations was really very rewarding. So a great year, I think, this year. Now the sort of things that we brought out that you're not normally going to get, that access to those really quality professionals without meeting them at a conference like this.
We believe in doing well by doing good. We have decided to put the vast roof spaces of shopping centers to good use and install solar plants at the retail investments of the Momentum Direct Property Fund. We have cumulatively invested more than 2.1 billion from our shareholder portfolio in renewable energy projects in terms of onshore wind and solar photovoltaic. We are already reducing 6,732 tons of CO2 emissions, which is the average annual emission of 969 individuals.
Did you know that South Africa has 73% sunlight hours during the day?
Johannesburg has plenty of sun. It's one of the top in the country.
Yeah.
The tariffs that you're offsetting here are particularly high. But really, solar works anywhere in South Africa now. 8 years ago, 9 years ago, everyone thought solar power couldn't pay for itself, that it was a technology that was a nice to have.
Yeah.
Today, you see it as a way to really enhance your assets,
Yeah.
to find untapped potential and untapped revenue
Yeah.
within your buildings, within your shopping mall, within your factory. Iris brings the roof space, the tenants, the load, and the ability for us to take our skill set and their skill set and marry the two to create an investment that is quite compelling for the shareholders.
The property portfolio has embraced the net zero target by 2050. We believe it's quite achievable by a combination of investment into smart technology as well as further renewables within the fund via solar. We believe it could be achievable even before 2050 should government legislation allow us to sell surplus power into the national grid.
Supporting and growing our economy at every level is a key driver of building a better future for all. Because with us, investing is personal.
We're struggling as a country, we're struggling as a community, we're struggling as a society, and I want what I know to make that a bit better.
Being a leader means being able to make a positive impact in someone else's life.
In the last few months, we interviewed 900 students in an effort to choose 2 candidates to spend 18 months in our business.
My name is Bafana Mutweni. I'm 24 years old. In 2016, in January, I received my results and that I had been accepted at the University of Johannesburg. I studied and completed my BCom Finance degree. On the 27th of July, I got the call that they're offering me the internship, and it really was the highlight of my year.
My name is Paulina Muwenda. In 2019, I completed my BCom Finance degree. When I first heard that I got accepted for the Phambili internship, I was quite thrilled. It was so exciting.
Our business is all about building a better tomorrow. We committed to our ethos of doing well by doing good. And part of this means reaching out to individuals, opening the doors of potential for them, and bringing them into our family.
What this opportunity allows me to do is to know more and educate the people that I know and the people that they know better about money, about investments.
It has made me persistent, driven and resilient, and most importantly, it has taught me to work very hard against all odds.
Protecting planet Earth has become more and more important in the past 2 decades. And as the custodians of planet Earth, it is our responsibility to look after the environment. Umoya means wind, and today we've traveled to the incredible West Coast to visit the Umoya Energy Wind Farm. Sabri, tell me a bit about the Umoya Energy Wind Farm.
This land was actually purchased to explore phosphate mining. But at the same time, the renewable energy industry started picking up in the country. And then obviously the shareholders and investors thought, why not? So we were awarded a power purchase agreement to supply about 65 megawatts. We ended up with 37 wind turbines with a capacity of 1.8 megawatts each. And that is all able to then supply at full power and meet the demand of our power purchase agreement and our contracted capacity. All of that energy is exported via underground cabling to our substation, facility substation. And then that is further then stepped up from 33,000 volts to 132,000 volts, which is the capacity that the national grid is operated at. Roughly half of the land that was bought has been designated as a conservation area. And that will eventually be absorbed into the West Coast National Park. There's an economic obligation that we need to meet, where the IPP plows back into the community. And these are some of the most historically disadvantaged communities that our economic development and our social enterprise development team sort of works in.
Through partnerships and commitments like this one, we can all build a better future. Because with us, investing is personal.
We've just concluded our think tank conference for 2023. Having had this event now for this is the 22nd year, we've pulled together probably the best and most diverse range of speakers that we've ever had from right across the world.
Fantastic, fantastic conference. Be exposed to such a wide range of speakers who are subject matters experts on all sorts of different topics at a time when the world is going through so much and there's so much uncertainty. Was just fantastic for me.
We've got some of the best fund managers from all over the world speaking at this conference.
The venue has been fantastic. We're obviously on level 34 of the Shard, which has been brilliant. Probably the highlight for me has been the M.M presentation, which talked about sort of generative AI and analytical AI and how Momentum is utilising that.
As usual, the conference was very professional. It's very well organised. A lot of time was spent on artificial intelligence, which was good to hear.
Highlights, I suppose, as being a social person, is mingling with people from all over the world. That was great. I think it shows a couple of things, that Momentum is truly a global business, but also the world is a globalized world. It was good to hear the commonality between ourselves and some of our colleagues and clients from around the world.
Hello everyone, again. Welcome back after your first coffee break of the conference. Hope you're feeling, I guess, awake and refreshed. Did you know that coffee and tea are not the only natural sources of caffeine? In fact, there is, I think, 60 more species of plants that do have some naturally. You got plenty of alternatives if you want to be awake over the next couple of days. I'm thinking about cacao, guarana berries, so no, you have plenty. Why am I telling you all this, other than stalling a bit? We love having alternatives. In investments, having alternatives means very often having an edge, having value on top of your usual investors. And today we have Wei Li Zhou, Head of Quant Equity at Robeco, who's going to tell us a bit more about how to take advantage of alternative data in the investment world to reach new investment heights. So please welcome Weili Zhou.
Well, thank you, everyone. It's really a great pleasure and honor to be part of the Momentum Think Tank Conference this year. So today, I would like to share some insights from Robeco regarding how we innovate and how we achieve and reach investment heights for clients. Data, computing, advanced algorithms, these are buzzwords and actual things, really bringing tremendous change in all aspects of our lives. And also including the way we invest. And these are also the advances that have already enabled what we call next-gen quant investing. So today in this particular talk, I would like to cover 3 areas of next-gen quant investing that have already made their way into our clients' portfolios, and actually with the promises of many more to come. So the 3 topics are alternative data, machine learning, and NLP, the natural language processing, followed by conclusion and Q&A parts. And before we dive in, I hope that we could have very quickly the time to look at 2 slides that sets the context of this talk. Now, the first context slide is this one. There are 3 major secular trends that we see are transforming the world we are in. I think it's also pretty much related to the content from the previous presenter. So firstly, we see the explosion of data. Nowadays, in every 2 years, the amount of data that are generated actually is equal to all that have been generated previously in human history. So when we look at, right, one investment decision nowadays, the availability and the dimensionality of the information sets that is available, that is overwhelming. And in a way, you can say this is a blessing, but maybe also a curse. Well, luckily, we have the second trend, which is the explosion of computing power. According to the law of accelerating return, which is also known as the Moore's law, the computing power doubles approximately every 2 years. So the number of transistors on microchips, that doubles. So this is pretty much the case in the last 50 years. And we're also glad to see the access to computing power is also easier nowadays, thanks to the great stuff like the cloud technology. Well, lastly, I would say we are also experiencing a galloping space in AI industry, thanks to the first 2 trends. More data, there's more computing power. Tech firms like Google, OpenAI, they're really pushing the frontier of the state-of-art AI algorithms. And this is fantastic news for our quants, because we have the domain knowledge and we know really how to combine it with these state-of-art AI and lead to better results for our clients. So all these things put together, data, computing, and algorithm, it is very clear they've brought us to the new era, whether we like it or not. They've also increased the competition level, but also offered new and unique insights. And this is the second context slide here. So it is about AI. What do we mean when we actually, talk about AI nowadays? So AI is actually a very generic and catch-all term, right? Underneath, there are specific technologies actually being developed for more than 70 years. So it's not really a new thing. And if we look at AI, we have the machine learning parts. So machine learning, they identify and they predict patterns in data. So if you think about it, actually maybe you don't know, but linear regression is also a form of machine learning. But nowadays, if we refer to machine learning, very often we talk about more sophisticated models, nonlinear models, right? Like a random forest, gradient boosts. So this is, I would say, a big part. And within machine learning, we also have the deep learning. And when we talk about deep learning, usually we refer to the neural network models with more than 1 layers. So these are also the more dominant form of machine learning models that are prevailing nowadays. And next to machine learning, we also have NLP. That's the natural language processing algorithm. They analyze, they read the text data. And actually, if you think about it, it's very useful because much of the financial information, they're not per se numerical, right? A lot of the information are textual or audio. So think of the speeches that C-levels are given. Think of the news, think of the analyst reports. These are all the information that could be very well handled by natural language processing. Well, in the end, we also see in the middle this LLM, which is large language model. Some also refer to the generative models. This is where the neural network and very advanced deep learning technique being applied to the NLP tasks. So if you look at how exactly it does, for example, the specific and unique skill it has is to look at a joint probability rather than conditional probability. You ask a generative AI app to draw a boat. You see the boat on water. Because for the data it's trained on, it knows that whenever there is boat, water must be nearby. So this is what the large language model and the generative models giving us. Now that we've set the context, I want to move on to the first topic, which is alternative data. So when we talk about alternative data, I think it's good to show how big the change has been in the past 10 years. This is a graph that's more or less summarized the landscape of alternative data, the infrastructure, the platform providers back in 2012. So that's 10 years ago. I think quite a lot of familiar names are coming back and logos. I think, yeah, it's also clear that it was already very busy, right? And now very, I would say, comprehensive. And if we move forward, and we see this is the picture in 2021. So I think it's even, you don't even need to bother looking at the exact logos and names. It's just very, very difficult. I think what the message we want to illustrate here is that the complexity and the pace of alternative data that's been developing in the past decade is just amazing. And what do we mean exactly by alternative data? Right? This, what do we mean by alternative? So I think first let's define what's traditional data. Now, traditional data is often related to financial statement, right? To the leverage ratio, the profitability information that we can find back. Also, the market data, price, return, volatility. These are the traditional information we make good use of. While alternative data, that's anything that is non-traditional. It can be the credit card transaction. It can be the satellite map image. It can be the Twitters, and it can be customer reviews, all these kind of informations. And it's usually categorized by 4 V's, right? Volume, huge volume, a lot of them. Velocity, right? Came in very quickly, can be any moment, real time. Variety, different forms, unstructured, text, audio, video, pictures, you name it. And veracity, so most of the things maybe are true, but there are also noises. So you need to be very careful when you look at what alternative data set is bringing us. And I would say that from our user experience, we do see alternative data bringing us different dimensions and different angles of insights that help us to understand the world, understand the companies better. And it does also tend to be more up-to-date, more forward-looking. So if, let's say, the quant work is to do nowcasting or forecasting, I have to say that alternative data really help us to do our job better. Now, here is a concrete example of the alternative data that we look at and being researched by team. So this is the penalty and fine that's going to levied on companies by government agencies. And we also find there are NGOs really closely monitor and collect these kind of information. If you think of fines and penalties, right, these represent legal transgression. So it's saying that whether it's doing fine or not legally. But at the same time, if you think of these information, actually what it brings you is the quality of management, the healthiness of the culture. So actually it can tell you a lot of information about well-being of a company. And what we also looked at is not only the size of the ticket, let's say how big the fine is or how big the violation is, we also look at the frequency, or in other words, autocorrelation. Let's say, is a company a serious offender of rules and regulations? And what we found from our research is that, yeah, the performance, long-term performance of a company that tend to be a serial offender will be worse compared to the non-offender. So there is always the pattern in it. Yeah, and this is also one of the type of alternative data we use. Now here is the second example of alternative data that has been researched but also deployed in a strategy. And it's China specific. I heard the Chinification, but this is also special attention for China. Why? Because the stock market in China is unique in the sense that it's relatively new, it's not with a very long history, but at the same time, it has unique regulatory setup. And if you look at the nature, it's also a bit more closed, right? It also have a lot more domestic investors, particularly the retail investors. So the government actually, back in the 2000s, they already put a law in place and saying that for institutional investors, if you're interested in a company and if you're paying visit in a listed company, that needs to be documented and that needs to be disclosed. Because the institutional interest, right, facing, I don't know, 70, 80% of the retail investors in the market, and institutional interests in a company could be very, very material. And so these kind of information of on-site visit, management meetings of listed companies in Shanghai and Shenzhen, these information actually you can get it from the regulator. And this also really indicates, right, what kind of companies, what kind of industries are gathering attention from investors, large investors. So we do have this kind of signals not only for stock selection, but also industry timing. So for example, if a lot of visits happened in the, I would say, biotech industry, well, that says something about the popularity and I would say sentiment around this industry. So these are just two examples of alternative data that we make use of, but actually there are many more that we already deploy and implemented in our production. So for example, scraping the job postings on companies and getting an early feel of whether the business is doing right or not. These are all very, very useful. But I think it's also good to signal, right? Given the alternative nature of these kind of data, it is crucial to be extra careful and to be extra cautious with the quality. And it is not that, I see something with very good test results in a very peculiar context, and this is, yes, good to go into your model. And it's really important to consult with the fundamental team or experts and double check and validate the history of the data. Because there is all kinds of purposes, right, of data vendors to manipulate it, to tune the history in such a way that it gives the alpha, good alpha in your backtest. So we need to be extremely cautious in this regard. And next, I would like to move to machine learning, how we look at that's a very powerful tool in extracting alpha for our investment strategy. What is machine learning? I think in general term, it says machine learning algorithm that improve automatically and through experience and by the use of data. I think it's a very general description. So from a quant researcher, so I've done quant research, I would say, for more than 17 years. So what I have seen is that by the deploying of machine learning, really the relationship between data, outputs, and human researcher is changing. Because in the traditional context, right, me as a researcher, I have a pre-selected model. I have assumption of what the relationship, best relationship is between the input and output, and I test it on the ground. And then if it's not close enough to the target, I would tune something, and then I'll put it on the run again. While this is different in the machine learning era, because my role will change from instructor to orchestrator, right? I will specify this is the input I would use and this is the target I want to predict. And machine, you tell me what is the best relationship description between these two things. And then we do not assume or too much pre-specify, let's say, what is the functional form and what should be the best definition and which model should be the best description of the relationship. And let model, let's say, recursively find itself via different scenarios, via different parameters, via the cross-validation checks, and come to me with the conclusion. So in that regard, I would say it already puts down a very distinct advantage of machine learning, which is the efficiency gain, right? It is identifying features' importance by itself, and it's correcting itself by looking at all these measures. And a second benefit, I would say, and it's I think most important for quant investor, is that machine learning gives very good insights into the nonlinear relationship and interactive relationship. So human tends to think in a linear way. This is good, this is bad, stock return go up, stock return go down, right? This is very straightforward. Okay, we can incorporate certain degree of nonlinearity in our assumption and imagination, but there's limitation. While model and the machine, they don't have this constraint. They can test all kinds of nonlinear relationships and then come up to the insight that it is beyond the original assumption of researchers. And they can also very nicely find the interdependency between variables or signals. So a factor A would be only useful if factor B is turned on. Well, I think this is a very, I would say, insightful, and it's also not straightforward for human to depict. And the third advantage is that it's very forward-looking. So there are all kinds of ways in machine learning experiments that can, prevent overfitting and making sure that really the selected model and functional form has the best out-of-sample track record before you really deploy it in production. And it changes over time. So if one signal was very important back 30 years ago, but importance and information has just got consumed completely over the last 30 years, it will not show up in the machine learning specification. Now, having said that, here is a concrete example what kind of interactive relationship that machine could provide us with. And this is also an example of how the classic signals or quant signal could be enhanced to a higher level thanks to machine learning. So as we probably all know, that price reversal is a very well-known anomaly in the stock markets, particularly predicting the cross-section of stock returns. Because if you look at the recent performance of stocks in the cross-section, right, those who have experienced the biggest jump or biggest drop, actually the price tend to revert. Because in most of the times there is liquidity pressure and pushing back the stock price back to their normal expectation. Now, however, if you think, hey, about the reality, there are always a lot of news going on with stocks. Some more, some less. Some more than it normally has. And if there are a lot of news going on with a stock, then we could logically expect that the changes in stock prices are very well grounded or substantiated, right? So if there's downgrade news about a company in terms of credit rating, we would logically expect it not revert after the price drop. So we did this checkup, and then machine showed us. So on average, right, we see a performance spread between the past winners and the losers about 16% on annual basis. However, if we double sort and if we interact this with the amount of news that are available around the stocks, and then we clearly could see that for those stocks that have little news around the extreme price movement, their reversal is dramatic, and the spread could be doubled to about 30% between the top and bottom groups. Well, if we look at the stocks that have a lot of news and really big things going on, the reversal hardly happen. So for a very well-known effect, a quant anomaly, by having machine learning detecting interactions between reversal, past performance, and the news volume, we could already extract the alpha in this context. So this is a second example of how machine learning could bring us into the new insights that is not easily available. Now, thirdly, I want to move to NLP. The natural language process is also kind of algorithm, and it's also very much related to alternative data given the input. So these are algorithm, right? Reads and analyzes spoken or written text or words. And underlying, actually, there are different types of NLP algorithm. Some NLP are good at looking at the sentiment, happy or not, positive or negative. Some NLP technique look at, for example, how evasive are you, how concrete are you in your message. And this is particularly useful and when we are looking at the CEOs and CIOs talking, right? And they're also, as NLP, looking at the topic modeling. So what is the trendy next big thing in the news and in industry? But before all these algorithms could be turned on, there are common steps needs to be taken to make it into that stage. Now, firstly, the gathering and the cleaning part. Cleaning the text data, corpus in NLP speak. And then we have a lot of sentences. What we need to do is to chop these sentences into words, into short phrases. And then we can translate these words and phrases into mathematical factors. So for example, you can chop sentence in Paris, France, Germany, Berlin, and then you know, hey, the mathematical relationship is that if Paris minus France plus Germany, and we'll have Berlin, right? So this is how I would say machine translate text into mathematical relationship, or king minus man plus woman, that's queen. So this is how I would say machine and text, let's say, transform into text. And then once these factors are made, this is the point where we can start all these algorithm tests. Sentiment, very important, because a lot of the news, executive communications, when we run the NLP algorithm here, we look at, is it a positive news or is it some negative message? And one step further, how positive and how negative. So we can even put a degree of magnitude to it. Secondly is the zero shots classification. What is this message about and what is this message not about, right? Is it about a new product or not? Is it about, how we say, earning a price or not? So this is the classification case. And third case is also very interesting. It looks at the similarity. So similarity can happen in two ways. One is like look at the description of business. How close are they? How related these two companies are? And the second is that look at the Q&A. You know, how good is the answer in answering the question? Is it beating around the bushes or is it really two straight points being raised by this question? So these are, I would say, concrete examples. But how to translate into alpha? Performance. So here is one example looking at the sentence similarity. And this helps us to reclassify stocks into different groups than the standard classification, right? We all use GICS, right? We look at 11 sectors. According to those classification, then you have Netflix separate from Apple, from Amazon. It's all in different sectors. And we all know that similar stocks tend to move in the same way, right? But these are different sectors. Are they moving the same way? Yes, we think so. And quite often we see that's the case. But how do we see the linkage between them? If you look at the description of their business, if you look at the communication of executives, actually there's a lot of similarity in the sentences. And so where is their growth focus? Where are they investing in the cloud technique? And then you can remap the group of stocks by looking at the business they are in, the communication they are in, and the description. So on the right-hand side, you see this new network. We call it the RICS, Robeco Industry Classification System, instead of GICS. And there we see, right, Apple, apart from Cisco, right, which is in the same sector, actually it's also very closely related to Amazon, to Facebook, or Meta, sorry, nowadays. You can see this is not a new invention, right? IBM or NVIDIA even, because of the business relevance and I think maybe the common AI exposure here. So this is really triggering us to rethink, hey, when we look at the industry momentum signal, right? One group does well, the rest will follow from the same group. Should we look at this alternative group? Or when we look at the risk management of our portfolio, instead of the sector limit of 1, 2, 3, 5%, should we look at the group limit instead? So this is, I think, an actual research we've been doing. Or the other example I want to put down here is the value of earnings call that could be extracted by NLP technique. This is also a signal that we deploy in our strategy. So I think earning call transcript, that's probably a very common topic and idea being spun around for a while. We've also been looking at earning call transcript for a long time. At the beginning, we focused mainly on the executive communication, right? So we think of, hey, what was the script parts told by CEO, CFO? Well, interesting thing is we saw that these executives, they're learning. They're learning very well and knowing what kind of words and buzzwords and the positive words were better received by analysts or by machine on the other side. So you see very interestingly that the average sentiment score of the executive communication for the script part is really improving over time. Now, however, if we focus, change it a little bit, and we focus on the Q&A part, which is unscripted parts by analysts, and then the freestyle conversation between analysts and a company, and there we found really the value is much bigger. So if you look at the alpha, let's say, in the top and bottom group, suggested by the Q&A from the company's answer, or the Q&A part from analysts, mostly the questions, and there we do see that the sentiment score, right, being a very strong alpha indicator. And you see even more from the question parts from analysts than from company. So sometimes a question is an answer itself. Like, do you have a severe solvency problem, right? So that kind of question is already kind of alluding to what the company is probably experiencing. And we also take it one step further, because here we show the value added of using different language-based NLP technique to add on top of each other. So when we look at, again, the Chinese companies, right? So you can do the Chinese NLP and to see what the signal is and sentiment is. You can also use the English translation and then apply the an English NLP on top of it, because it's the trained data and the nuances is just different. And what we have found is that they are not identical. The outcomes are not the same. While they seem to contain orthogonal information on each other, and while combined, it seems to give us better outcome. And this is also quite nice development that we're doing, because, yeah, emerging market is a very big investment universe for all of us. So having said all that, this brings me to the final conclusion. I think, yeah, no matter we like it or not, AI and the new technology, alternative data is there. It is not like on the way, it's already something that we live and breathe on a daily basis. It really has lower and lower barrier nowadays. So if you have access to OpenAI, or if you have some connection, right, you can already deploy it quite easily. But I think as professional investors, am I worried? Yes and no. Because at the end of the day, I think these toolkits, they're still used by humans, used by people with a lot of domain knowledge. And we are training these AIs and data to serve the purpose and to give us the new insights. So I think in today's world, when these toolkits are so popular and so accessible to everyone, having the right investment knowledge and insights, and always ask yourself the question, critical question, does it make sense? Can you explain to yourself? Can you put your own money in it? I think it makes you look at the game and look at investment from a different perspective. And of course, we are very happy that many partners of ours and clients of ours are in this journey together. So we are also having a lot of conversations and being challenged on a daily basis. But that's fun part of the work we have as a quant, so to say.
I'm going to introduce our next speaker, who is from Musenish & Co., who's a manager of corporate credit that at Momentum we've worked with them since the financial crisis, since I think we probably first invested in 2008 in high yield strategies and emerging market debt, and also in sort of shorter dated and crossover type strategies, which our next speaker manages. So I will hand over to Tatiana Grau-Castro, and I will talk to you later.
So nice to meet you all, and I was lucky enough to hear the previous two speakers, and I was really engaged, by the stories they managed to tell about the individual companies everybody has heard of, and also AI that everybody now talks about, and so yeah, I feel really thankful actually for being invited to a conference like this, because all I talk about is corporate credit and yield curves. So that throws you back, right? So when the previous speaker talked about, the speed of trading and things like this, well, I tell you how we are trading. We are calling people up over the phone and say, "Are we done?" "Yes, we are done," right? So yeah, this is sort of a little bit back into yesteryear, so to speak, but still very, very, very present. Alrighty. So a few things, there's very, very, very small, but there's actually there's a few things I'll talk about. One is the shape of the yield curve, because I think it's really important. And then the other thing is, what are the benefits of short duration? And then I'll say a little bit about, how do we see value, Do you like high yield over investment grade? Would you like US over Europe, emerging market, financials, right? So you can pick and choose, and we give you some data on how we do that. The shape of the yield curve, I think it is so important. As we know, or probably most of you, and this just shows you the two most important yield curves in the market, which is the US Treasury curve and the German Bund yield curve. So as you know, a lot of fixed income products are priced off that yield curve. And it goes here from the 3 months to the 10-year, but it goes out to 30-year. There's a few longer ones, but most of the action is inside the 10-year. Usually, the yield curve is downward sloping. So usually, the yield curve has completely the opposite shape. It goes, the shorter dated is lower, and then the further you go out is higher. Makes sense, because the further out you go, the more you need to get compensated for delaying your gratification, the less certain the world is, so you need to get compensated for this. So having an inverted yield curve is very unusual. And we don't have a slide here in the presentation, but we've done some analysis. I mean, this is by far the most inverted yield curve we have ever seen, and it's usually a very short-lived phenomenon. Now, why did the yield curve invert about 15 months ago, I would say, roughly? It was, I believe, that everybody said, ooh, high inflation, higher interest rates, that will cause a recession. Therefore, the yield curve needs to be inverted because we are already anticipating the recession. But what we always point out is that that is a fallacy, because that in previous times, an inverted yield curve was a good predictor of a recession. But, coming back to the previous speaker about machine learning, even humans learn, right, to look at previous periods, and they say, oh, previous, this is how it worked out. So I know exactly the playbook, how it will work out this time. Yeah. If everybody thinks that, there is Charles Goodhart here from the UK, used to be at the Bank of England and the LSE. And Charles, he coined the term the Goodhart principle, which means that if everybody is looking at an indicator as a forecasting tool, then that tool is losing its predictive power. And I feel that the inverted yield curve is just that. And that's why, over the last 3 months, we have seen a disinversion of the yield curve. What does that mean? Some people also call this a bear steepening. A bear steepening, a bear clearly is negative, right? For us, yields going up means a negative price. So a bear steepening means that yield curve was even more inverted, and it is slowly coming up a little bit. So that's a disinversion of the yield curve, or a bear steepening. There's no steepening, by the way, it's flattening, but it's just the lingo. This is what we've seen over the last 3 months. Why is that? Because the market is sort of catching up with the Fed, and the Fed is telling everybody, oh, we are manufacturing a soft landing, right? The market didn't believe it. It was positioned for a recession, and now they say, maybe there is a soft landing. So that's why the yield curve is not as inverted as it used to be. So that is the situation we're currently in. Now, what do you do in this situation? There's a few obvious points, and I think that's a short duration to us is something one should consider. One is if the yield is the highest at the short end. Some people also refer to yield as a carry. Right, so if you just want to sit on it and it carries you along, right? So nothing happens. You lock in that carry. That's great. I mean, so you get the highest carry in the short end, where you take very little risk, right? Sovereign debt, the US is not going to default over the next 2 years. You get paid 5.5%, versus in the long end, this is a little bit, because it's from the end of August. The 10-year is well, a little bit higher now than we have here, but roughly where we are. So you get paid more in the long end. You just sit on it. You get that carry. In 2 years' time, annualized, you get 5.5%. Pretty good. Whereas here, right, the 4%, it could go higher, then it goes against you. Or you could rally, and then you have a nice multiplier effect. And that's really what everybody's going for. Because the only reason, really, you are buying duration with a lower carry is that you think that the yield will rally, meaning it goes from 4, let's say, to 3.5%. And then, if it rallies, you want to own it, because a 10-year yielding instrument has a duration of 8. And what does a duration do? It's a multiplier effect. So even if you were to rally only 0.5%, but you multiplied by 8, so 5 times 8 is 4%, right? Where 0.5% times 8 is 4%, plus the initial carry of 4, so you would make 8%. So carry of 4 plus the return of another 4%, you would get 8%. In the short end, let's say, if we were to rally by 0.5%, we go from 5.5 to 5, but the multiplier is only 1 point something. So, because I'm not so good in maths, I do one times. So we are going 1 times 0.5%. It's 0.5%, right? Times the carry of 5.5, you get 6%. So you get 6% in the short end, and 8% in the long end. That is assuming everything is a parallel shift, everything rallies by 0.5%. Okay? Now, I'm jumping forward. This is all well and good, but we don't know. So, given that, as I said, the yield curve is usually upward sloping, and that sort of makes sense, and that's, I think nobody's arguing that we are not going back to a upward sloping yield curve at some point. So that we know. If it is currently inverted and we are going to upward sloping, it's like a seesaw, right? So if we are going from currently inverted to upward sloping, that means at some point we need to be horizontal. At some point it has to have exactly the same yield, right? Has to be. Even if it's just for a second, it has to be, yeah? And that, if you think along those lines, it helps you. Why is it so important? Because, the big question clearly is, if we are going from, I have to go back to this one, I was a little bit too quick. But if we are going from this inverted yield curve, to an upward sloping yield curve again, right? So at what level is it going? Will it be flat before it tilts? if it is flat at the 4% one, then I gain 1.5%, you know, times 5.5% is 7%, and here I get 4%. So you are better off in the short end, right? If it was to flatten at 5.5%, you're clearly better off in the short end because you make 5.5%, but you lose a lot in the long end because you go from, again, you know, we round it for easy calc, is 1.5%. You lose times 8. That's a lot, right? And then you subtract the 4% that helps you. So where it will be flat is very, very important to think about. And we have done some calculations here. Because, you know, if we know that when this inverts into, you know, further bear steepening or a bull rally. So here we see, and this is the slide that's sadly we haven't updated, is from the end of July. And clearly, you know, at the end of July, the yield curve was at 4.1. Well, it's not that much higher. It's somewhat higher. But let's say we just stick to that, right? 4.1%. And then we say, if the yield curve flattens at 5%, at 4.5%, at 4%, at 3.5%, at 3%, at 2.5%, and you will see, it makes a lot of sense, you know, if it flattens at a lower yield than where the 10-year is at the moment, then clearly you get a huge return. So if it was go down to 2.5%, you would make 13%. But if it flattens at 4%, you would only make 0.8%. Clearly, if it flattens above where the current 10-year is, you would lose money, 3.3%, 7.5%. In the short end, let's use the 2-year, right? That was at the time 4.8%. It's now 5%. But let's use the, you know, that as a starting point. If it goes from 4.8 to 5, so 20 basis points higher, you lose 0.3. If you go, you know, anything below, you will clearly start making money. So it is much easier for the short end to make money than for the long end because we have a higher starting point. Yeah. And you don't have the multipliers. The only reason you want to own the duration is because you are hoping for further rally. But the yield curve is already inverted. It has already priced in the recession. So where are we rallying to? Yeah. So that's, I think that's a good sort of frame. It doesn't give you the answer, but it gives, I think it's a very helpful framework to think if you want to own duration or not, given the shape of the yield curve today. So that's sort of, I think, what everybody in fixed income is thinking about at the moment. I would hope they do. Some don't. They're very greedy. They just buy duration. Have been buying duration for the last, 12 months. Too early, clearly. We argue it's still too early, and we argue that there is still, we are still in a transitionary period because the yield curve is so extremely inverted. And whilst we are transitioning to a normalized yield curve, it's too early to own duration. Because when you look at the return profile of the different scenarios, most of them are against you at the moment still. So yes, own duration at some point. I don't know, depends on how quickly sort of it normalizes and clearly what's happening in the next few months. But I would say you can probably give it some time still. Okay, sort of that's the underlying. Let's jump to credit. So this is another way to think about it, this just sort of practically is when you can see here global investment grade corporates, right? So this is just the index, and it just shows you sort of the returns we have experienced over the last 3 years. And so it shows you the value of short duration with regards to containing volatility. And here, this is just the index, and it says the 1 to 3 year global corporate index, and you see how the price has moved over the last 3 years. So the lowest point was 95, whereas the long data, so the 10-year plus, over the last few years, at its maximum, it had lost, when we go from 110, right, at the end of 2021, down to 70. So, it has lost around 40 points at some point. So it's very, very volatile. Yes, the price point is still much lower, and there will be this pull to par, and I have a slide on this that explains it. But that volatility, we expect it to continue. It's a little bit too early to have that duration, whereas here the pull to par goes very quickly. Pull to par, actually, and I'm sorry I'm jumping around, but I think it is a good one. What is pull to par? So, if you have a one-year bond trading at 95, and the one-year bond has a 5% coupon, we have a 2% coupon here, it doesn't matter, but yeah, we can have the 2% coupon here. So you have a maturity of 2025, so that's 2 years out, and you have a price point at 96, and the coupon is 2%. So the yield to worst at the moment would be to maturity. But why? The yield, and it would only be 3.3%. Why is the yield to worst to maturity? Because it will be 2 years that you're going from 96 to 100. Because at 100 you get repaid at maturity. So it takes 2 years for you to gain a 2% coupon, and 96. So the first year you will only make, if it's linear, first year you will only make 2% to go from 96 to 98, roughly. And then you add another roughly 2%, clearly a little bit more. So that gets you to 3.3% yield, because it takes 2 years to get to maturity. But if the company repays you a year earlier, which a lot of high yield companies do, that they can repay you early, so then if the company repays you a year earlier, you have 1 year to go from 96 to 100. So you make that 4 points plus the coupon. And so actually your return looks much better. Now, it's a convention that everything gets calculated, and yet everybody uses Bloomberg, it gets calculated as a yield to worst. We always look at the most conservative outcome. And so the yield may tell you that the yield is 3.5%, but actually your return profile is much larger to the extent that you get repaid earlier. And this is the power of the pull to par, or pull to par even, especially when it's earlier, that generates a better return than the yield is saying. And, when we're going back to the very beginning, and it gives you protection against volatility, because the duration is so short, and you have to go back to 100, because the company repays you at 100, right? I always say it's completely different to the equity market. You need to have another person to sell the bond, the equity to. Here, when it comes to maturity, I don't need the market to sell my bond to. No, the company comes and picks it up, themselves, and say, well, I pay you your money back. Thank you for lending me the money. I pay you back at 100. Doesn't matter if the market is up or down. It will always get back to 100. So now, where do we see value? So clearly, we've already established we see value in the short end, and that's because of the way the yield curve is shaped. So you have a higher carry in the short end, and you have better downside protection. But then, do we like US over Europe? So here we have European investment grade in yield and US investment grade in yield, but we converted it into euros. And that is something that a lot of people fail to do. You cannot look at the 2-year treasury at 5% in dollars and compare it with the 2-year two-year bond in euros. You need, if you are a euro investor, you need to take roughly 2% of the yield, because when you convert it into a euro return, that's what you're losing. Same thing when you go into the 2-year bond and you're a dollar-based investor, you need to add 2%, right? So we show the yield here in US investment grade converted into euros, just to compare like for like. So we take 2% off. So we see this is the yield clearly higher than it was over the last few years. But then when we compare the European yield to the US yield, then we see that the European market is significantly cheap to the US market, just based on yield, if you compare like for like. When we compare it to spread, so this takes the shape of the yield curve out. It's only the credit spread that we can skim off on top of the sovereign yield. And here you see European investment grade trades wide to its own history. US investment grade trades in line within its own history, again indicating that European investment grade trades cheap. Then when we look at, I told you already the underlying sovereign curve is inverted, but what happens if you want to buy credit, right? Because we get credit spread on top. Interestingly, credit spreads are only very slightly inverted in Europe, and in the US there's sort of a smile, so to speak, but also relatively flat. And so you don't get paid extra by being in duration. You get the most bang for your buck, so to speak, with regards to carry in the short end. So again, that tells you that this is something that is very attractive. When you compare it then with your volatility expectations, so your risk reward, again, points to the short end. When we look at credit quality, and here we have the credit quality of US BB single Bs over triple Bs. So do you get paid for taking credit risk? Well, when you look at the yield premium of the BB single B market in the US versus the triple B market in the US, you see no, you don't get compensated for taking credit risk. In Europe, similar, you don't really get compensated for credit risk. So I know a lot of people have felt that they lost out of not owning high yield this year because it has performed well, especially in Europe. We caution of chasing the rally because a lot of people do that. They look at past performance. They say, ooh, I got to go into that. Again, we're not stock, right? We're not going up endlessly. There is a limit in what we can do. When you look... and that gets me back a little bit to fundamentals. When you look at fundamentals, because then you think, oh, well, we're not going into recession. Why wouldn't we own high yield? Our argument is that we say, be careful, especially on the single B part. And why? If we have a stronger fundamental backdrop and interest rates don't get cut next year, significantly, and the year after, there will be more and more companies that will have to refinance at a much higher level. So they may have bonds outstanding at 4% today. They will have come to market at 10%. And if you don't have the cash flow, if you barely have the cash flow to pay a 4% debt burden, you will not have enough cash flow to be able to afford a 10% debt burden. So it's a little bit counterintuitive that you are negative the weakest part of the market in a stronger fundamental outlook. But given the slim cash flow generation of those companies, a single B company usually has a cash flow generation of between 0 and 10%. So for them, a significant increase in the cost of debt is unaffordable. So that's why we are cautioning, especially being a full access to high yield. Emerging markets, again, when you look at its history, doesn't really look like it offers a lot of value. Banks, absolutely. Bank paper is still cheap. Clearly, the bank sector was in the news in March with Credit Suisse and the AT1 not being paid, and then First Boston and the Silicon Valley Bank, and then the end, right? But it started already last year that people were cautious. They were concerned about Tier 2s not being repaid, Tier 1s not being repaid. There's banks look at the funding structure in a far more holistic way. So there's still decent value in banks. That's what we own. And then two more points only. One is, this is just another way of looking at the same thing again. This is break evens. So what does that mean? So, you know, we talked about return potential. You make 5.5%, you make 4% in different markets. Well, if the market goes against you, you know, I mean, how much can the market go against you before you start losing money? And, you know, clearly when we had negative rates or zero rates, as soon as the market went against us in a tiny fashion, so here that was at the end of 2021 when we were pretty much at the edge of, you know, negative zero yielding yields, and you could see that, you know, a slight diversion, a little bit the market moving against you, you started losing money, and we felt that strongly in 22. Also in the short end, you know, a small move against you and you would have started to lose money. Now you need more than 3% against you in the short end before you start lose money. And in the longer end, you know, it has only doubled, again, because of the inversion of the yield curve, but you have also better protection, but by far the best protection in the short end. So if you're only there, you know, for your investors and say, you know what, you get 5.5% and it's very unlikely for you to lose money, right? If that's sort of the mindset, then absolutely, again, it's the short end. And then one last thing I wanted to say, and that goes a little bit also to the question that was raised earlier about, oh, well, if everybody does it, you know, and how can you as an active manager outperform a passive strategy? Well, when we look at an ETF, it is only there to replicate a benchmark, right? It's not there to outperform a benchmark. So the starting point is already benchmark is good enough, right? I mean, that is, nobody ever tells you you're set to outperform the benchmark. The other thing is with, you know, volatility and sort of analysis, right? Clearly, ETF makes no analysis. All it does is liquidity and correlation matrix. It only wants to stay close to the benchmark. Doesn't do any analysis at all. Where you want to be, you know, like I told you, US versus Europe, emerging market, yes or no, bank paper, yes or no, high yield, yes or no. You know, I mean, an ETF doesn't tell you any of it, right? So that's that. Then the volatility, given that we have a premium and a discount model, clearly the volatility in ETF is exacerbated because that's how you get volatility, that's how you get your liquidity, is by offering a premium and a discount. So especially in volatile market gets even more volatile. Whereas clearly as an active manager, one of the things we definitely pride ourselves is to contain volatility. And then clearly the other thing is that an ETF is following very strict and often inefficient ways of recalibrating, right? Because the benchmark changes every month and therefore we need to recalibrate every month. And we are not beholden to that by any means. So we can have a far more opportunistic and flexible approach. So I just wanted to leave that as a last slide.
So, a sort of 15-minute whistle-stop tour, really, of how we think about fixed income today at Momentum and how we use them, how we use bonds in our portfolios. You know, for many of the last years, we've been heavily underweight duration. That all came to fruition last year, or the last couple of years, with bonds selling off a lot as yields backed up. So I'm going to talk a little bit, just a brief reminder really of the sort of bond landscape out there that we look at. Then I'm going to talk about the risk return payoff and how that's changed. We'll look very high level at maybe just a couple of pointers towards sort of valuation and returns. And then importantly, I think in the multi-asset context, how we can use bonds in portfolios to help add some ballast. So, Bond 101, really, left-hand chart here, interest rate risk up the vertical axis and credit risk along the bottom. Essentially, you know, down in the lower left quadrant, low interest rate risk, low credit risk, you'd expect a lower yield and a higher yield, obviously, as you move out along those lines. The sharp-eyed amongst you will recognize as well that there is an arrow at the bottom of the interest rate line. Reinvestment risk is very much a concern today. And whilst we do have these high yields at the short end, you can earn a decent yield in the short part of the curve and reinvest that. But at some point, if yields fall, then you may be reinvesting at a lower level. So the potential to lock in further out the curve is an important consideration. But certainly within this, I've sort of started on sort of three main areas, but certainly in the lower credit risk and the low to sort of moderate interest rate risk. Generally, that's the area that's sort of populated with treasuries, gilts, tips, bunds, etc. It's not an exhaustive list. Now, obviously, clearly, through 2022 and certainly the last couple of years, having that interest rate risk is not necessarily a good ballast in your portfolios at those times, and we'll look at that a little bit more. And of course, return. We've now got return from large parts of the market that were lacking that for a very long time. Emerging market debt just sort of edges out of that circle. You've got higher quality emerging market sovereigns and companies in there. But equally, there's the weaker credits, and that falls into more, the higher yield, higher risk strategies that are more sort of total return focused and probably income generating as well. You see there sort of AT1, CoCos, etc., high yield leverage loans. And then you've got a lower volatility segment as well, which is not without risk, certainly without credit risk, very much at the sort of front and short end there. You've got the sort of treasury bill market, and then out to the right, you've got ABS, CLOs, and such like. So when you put all these together, what sort of weaves them all together? Well, today, for the first time in a long time, we've actually got income back there as well. So we've got decent levels of income and better yields for the first time in a decade, really. So in terms of the risk and return context, let's have a look at that. I mean, for decades, really, up until the advent of quantitative easing, we had risk-free returns from bonds. We had good yields. We had no credit risk there. But this is since about 1989. Prior to that, we had double-digit yields, but those were crushed, from 9% levels. 10-year Treasury yield, getting right down into high 40 basis points. It was, and they kicked up a little bit since. And during that period as well, this is through to February 2022, so it doesn't have most of the rise. But duration, which is a measure of interest rate risk in the bond market, went up from 4.5 years to 7.2. And the higher the number, as Tatiana explained, that's a multiplier effect. So where you end up with is very low yields and a lot of duration risk, and what you ended up with was return-free risk. And how does that look? Well, if you go back to the beginning of those charts, the beginning of those lines in March 1989, we had a yield of about 9.3 on the Treasury and a duration of 4.5 years. So your yield per unit of risk, if you like, was over 2. So you're well compensated at that time. Roll forward, December 21, almost 2 years ago, and everything's completely reversed there. Just sort of 0.2 units of yield for each unit of risk. So not well paid there. And where are we today? Well, in a more normal environment. Callum spoke this morning about the rocky road back to normality, and I suggest here, a more normal balance, potentially further to go, but certainly within the context of how we use bonds in the portfolio, more attractive today. This chart here, every quarter we produce returns across a swathe of fixed income asset classes, probably too many. But one of the things that I do is I look at the break-even yield moves, which Tatiana also alluded to. And what you can see here is basically the height of the bars is how much cushion you have against yields moving up. Bond prices move inversely to yields. So as bond yields move up, so the price of those bonds go down. But obviously from a higher starting level of yield, which you earn over the course of the year, you can tolerate a higher move in yields before your total return over the next 12 months would go negative. And those highest bars there generally are the sort of shorter maturity, short duration asset classes that Tatiana spoke about. The orange lines that you see across the top, that was in May, I think taken at the end of April, the levels that we saw at that point. So generally we've had a lifting in yields in the interim period, which has added a bit of cushion to most of the asset classes. And also, I would just point out as well, going back 2 years, those little crosses on there, that is where we were 2 years ago. So taking the left-hand column of the US Treasuries as an example, and again, which we've seen, less than sort of 50 basis points move higher in yield, and you'd be suffering a negative total return over the following 12-month period. But today, yields could go another 2.5% higher on the two-year Treasury, pretty much, before you'd have a negative total return. So much more cushion today. And some of the worst, just worth pointing out, JGBs, the Japanese government bonds, which we don't own, wafer thin, yields are still very low there. But an important consideration is the hedging costs. If you take JGBs and hedge them back into dollars, you can add more than 5% onto the yield. So although yields have gone up in Japan, the actual total returns this year have been slightly positive because you get a big pickup on the hedging, but not that we own them. So in terms of valuations and the potential returns, I've just got a couple of charts here, and I could pull out many, but this is the ICE BAML 7 to 10 year gilt index. It's a cohort of 7 or 8 bonds, I think, and the average price of those bonds a couple of days ago was 85.6, and these bonds will pay back at par. We've heard from Tatiana about the pull to par effect. That is very powerful. The more discounted these bonds get, the more pressure there is that will take them back to 100, provided they're good quality. These are sovereign bonds in the UK. No credit risk necessarily to UK investors. To overseas, there is the currency risk, but that is a very strong underpinning to the market. And shorter maturity bonds perhaps will be discounted less, but again, the effect is still there. And actually, you can see we've been there, well, twice before. Actually, once in September last year, which was the Liz Truss sort of mini budget fiasco, when prices, fell very sharply, and we were sort of buyers of inflation-linked bonds at that time. We've had a little bit in gilts actually in July into some portfolios, certainly sterling portfolios, in the Harmony range. But here, back in, I think that was 1989, the last time they're sort of at that same level for the same index, if you like. Yields, market yields were a lot higher at that time, so slightly different dynamic. But over the next decade, gilts outperformed cash in the UK by more than 5% over the following 10 years. So the starting level of yields is different today, so that might be more of a challenge. But certainly, I think the outperformance versus cash potentially for the long term is there. And thinking about longer term holdings or longer term horizon, I'm showing here the US, on the left-hand side is the nominal 10-year Treasury. On the right-hand side is the TIPS, the Treasury Inflation Protected Securities, so inflation-linked bonds. And I'm showing what the forward return is, or has been, over the 10-year period, because these are 10-year bonds, for the starting level of yield. So, if the yield at this point in 2002 was, sort of 4% odd, I've gone to 2012 and I've looked back what the historical annualized return was, and it was probably sort of 4 to 5% or so. So the point being that over the shorter term, the mark-to-market effect, as we saw, over the last 18 months, is extreme on bonds as rates move. But with a longer-term horizon, and certainly on 10 years in this case, it's actually a pretty good indicator of what the forward returns can be, both in the nominal market and in the inflation-linked bond market. And at the moment, we're looking at, sort of 4+% potential returns on the nominal bonds, and 2% or so in the inflation-linked market, which I think is pretty good, given the uncertainty potentially for lingering inflation, geopolitical risks, economic risks, etc., to be able to bank 2% on a 5-year tip is, or more than that, it's actually pretty attractive. And then, of course, the role that they play for us within multi-asset portfolios is crucial, and again today, a vital part of the construct. Going back sort of 35 odd years to 89, and sort of just charting the move in the 10-year Treasury there to where we are today at about 435, 36. Now, what I'm showing here is how much would the yield. Remember that, bond prices move inversely to yields. So when yields fall, bond prices go up, and that's how we, help protect in one of many ways, but within our portfolios. So how much do yields need to fall in order to gain 10% from bonds, which is a function also of the duration risk, which we saw has changed through time, but by and large, and that's what you see. So, for a long period of time, I think we got to the bottom about, in 40 to 50 basis points in the 10-year Treasury. That was the low point where the dotted blue line is. But in order to, have 10% sort of ballast in your portfolio, then yields would have needed to fall to levels that, barely, probably lower than actually where bonds got to, at the height of sort of quantitative easing before that started to be unwound. So there wasn't a lot of protection there, really, for sort of 12, 13 years or so, really post-GFC. Today, with yields where they are, there is a lot more scope for yield compression and protection within portfolios if and when those rate cuts do come through. And then in terms of correlation, that's a vital part of the construct within the multi-asset portfolios. This is looking at the bond equity correlations, suggesting potentially that could maybe roll over. I think last year the reason that it became so correlated, it was the bonds that caused the sell-off in equities and the re-rating as they shot up. And we're at a level today, potentially where that could change and could roll over. But even if it stays high for a little while, I mean, the probability, given where it is probably more to the downside, I think, than to further upside. That could happen if we have inflationary, more inflationary shocks or lingering on that. But if we do see a continued moderation in inflation, as we saw in the UK today, with a big downside to the surprise there, with core inflation coming in at 6.2% versus, I think, 6.8 expected. That's a big miss. You've seen a big move in the gilt prices and yields falling. And then, just to demonstrate how they provide ballast in the portfolio. A lot going on here, but let me just explain it. So, going back to the post-war period, this is since 1946, and I've looked at the drawdown on the S&P through those periods, and each of those little dotted red lines that you can see coming down, by and large, I've sort of looked at, eyeballed where maybe sort of like a 10% drawdown. I think there are about 16 drawdowns or so of around or more than 10% during that period. Then what I've done on the bottom, I've looked at the 7 to 10 year Treasury index, and I've done a draw up on that. So from the point at which the drawdown commenced, I've looked at how Treasuries performed, rolling that forward. And by and large, you can see there's a mirrored relationship, and you can see how the protection can come through. I had to check some of those numbers on the Treasury index myself, 40, 50%, but they were right. You can see in the tails there as well, perhaps a slightly more muted response, particularly in the right-hand side of the tail, and definitely, the drawdown that we had last year, there was no draw up when that commenced. It was much later in the year, after bonds had repriced, because it was the bonds that caused the S&P to draw down. There was a little bit of a tick up, but not a lot of protection there. And that is for the reasons that we've seen. If I overlay the Treasury yield, that they'd just got so low and there was nowhere for them to go. So we had to be, very inventive in how we, construct portfolios, build in many levers of diversification into portfolios. We can't just rely on this sort of 60-40 construct, and that's why that traditional, balanced portfolio underperformed so much last year. So using alternatives, making use of cash, short duration credit, all of these things go into the mix. But now, with yields at a higher level, we think bonds have got a much more significant role to play in multi-asset portfolios today.
Hello everyone, and thank you for joining us for the first day of this year's virtual Think Tank event. We are humbled that so many of our financial advisor partners joined us from across the globe to gain independent insights from top international asset managers on the variety of global investment strategies available for globally diversified multi-asset portfolios. Even after attending the live event in London last month, it has been great to revisit the insights shared as we continue to navigate the rapidly evolving market conditions. We started the day with Berenberg, who covered the rocky road back to normal times, followed by First Sentier, who covered interesting stock opportunities in a country that has been overlooked, underappreciated, and under-researched, and that is Japan. We heard from one of our specialist growth managers at Jennison Associates on the secular growth markets they continue to focus on, including new developments in generative artificial intelligence, strong global consumer brands, and industrial automation, as well as their thoughts on de-Chinification. As you know, we at Momentum Global Investment Management believe in the benefit of blending quality, growth, and value investment styles to smooth the journey through the cycle. So you'll also be hearing from Artisan Partners and Sands Capital from the value and quality perspective over the next 2 days. As leaders in academia, Robeco covered the role of alternative data sources as inputs into the investment process. And finally, with fixed income increasingly becoming a valuable diversifier within multi-asset global portfolios again, Muzinich and Company covered the inverted yield curves in the US and Germany and the opportunities that can be found in short duration credit. To wrap up, just a reminder that the virtual platform will remain open until the end of November if you would like to view any of the presentations again. For South African viewers, please add your ID number, and for UK viewers, please add your advisor firm FCA number to the CPD section and watch the full 3 days of the event to earn the full points associated. Thank you so much for joining us today. We look forward to seeing you virtually tomorrow, where you'll get more insights from other external managers. Thank you.
Thank you.